All right, I guess we'll get started.
Over 35,000 square feet. 35 what? 1,000 square feet.
Now,
Big old building?
get started.
It's tough when you can call on him by name.
Yeah, I
Ooh,
know, right?
you want to be in his class.
Yeah. All right, I guess we'll get started. Before we get to our speakers, I just want to make a couple announcements. Since this is just my second meeting, running the meeting and getting the speakers, I'll introduce myself again. I don't think I did that the last meeting. My name's Darren Thomas. I work at Sobel & Company. I'm a tax manager there. I used to work for Witham, Smith & Brown, and before that, Deloitte & Touche. I'm going to be the state tax interest group leader for the next 2 years until June of 2020. And I'll post my contact information on Connect again in case anybody wants to get in touch with me to suggest speakers or maybe agenda items for the directors meeting coming up next month. Just want to remind everybody, there's going to be a joint federal-state meeting in October 18th, and we're still working on getting speakers for that one. I'm also setting up a meeting for November 28th, and the topic's going to be State Tax Nexus for sales and use taxes. So get to our speakers. Today we have Mark Klein and Joseph Vendras from Hodgson Russ, and they're going to give us our New York tax update. So let's have a big hand for Mark and Joe.
I don't have a big hand.
Thanks, Darren, and good afternoon, everybody. Actually, I put this on and I decided, as you know, it's 117 out, and so it seems stuffy in here as well. Anyway, we're going to talk, as Darren said, about New York State, some of the issues that have occurred over the past year. It's been fairly eventful in New York. We've actually got some interesting legislation, or at least attempts at legislation to talk about. We'll talk about some new audit initiatives. New York, as I'm sure you know, is pretty aggressive when it comes to finding businesses that are located here in New Jersey that are doing business in New York. And believe it or not, some of them may not even be registered. There's an interesting push going on right now. As you know, if you happen to do business in New York City, there's a chance you could owe New York City tax. I mean, New York City only taxes two kinds of businesses, right? Those that are incorporated and those that are not. Otherwise, you're good to go. But if you happen to fit into one of those two categories, you could owe the general corporation tax, now called the business corporation tax, or the unincorporated business tax. So if you wander over to New York City because you've got clients there, I assume you're all registered and filing, and if you need voluntary disclosure forms, Joe's got them here in his briefcase. But what New York City's doing, show you the level of sophistication. If you get more than 2 parking tickets in New York City, the registered owner of the vehicle gets a letter. Dear sir or madam, please tell us under penalty of perjury, what do you do for a living? If it turns out you're a CPA, you're a lawyer, you're a doctor, you're a plumber, you're going to get more questions under penalty of perjury. So they're out there and they're making a real effort. And I think one of the reasons, and this sort of permeates the entire discussion we're going to have this afternoon, is that New York, like most states, is out of money. But unlike most states, you know, Phil Murphy is brand new to New Jersey, so he's not going anywhere for a little bit. But Governor Cuomo in New York, he's got eyes on Washington. He wants to be your president one day. And as a result, he is not going to be known as the governor who raised taxes. That is a real quick death knell. So he's not raising taxes. Yet we're out of money in New York. Last budget showed us possibly $2 billion in the hole. So what do you do when you're out of money and you can't raise taxes? Well, obviously you cut spending. That's what we're going to do. Now, I always like to start with a joke. We can't cut spending. We've got unions, we've got contracts, we've got pension plans. It's not going to happen. So now we need money. We can't raise taxes. We can't cut spending. What do? We go after non-residents. You guys are the best. Why? By definition, you don't vote. You've got no political constituency. There's not a lot of love lost in Albany for people who are in New Jersey. So that's why we go after the other states. So let's talk about what New York is trying to do. Oh, question, sure.
I'm sorry. This letter you would get if you got 2 parking tickets in New York City.
Voluntary disclosure program applications are here, sir. Yes.
Well, okay, I don't drive to New York City except on the weekends anyway.
Take a train.
Are you required to respond to that question? What do you do for a living? Just because I get a parking ticket? how does that entitle them to know what I do for a living?
It doesn't. You can certainly stonewall, and then you will cause them to do what they generally do, which is to pull the computer records of every tax return where your name might be on it as prepared. And now you are doing business in New York, whether you're physically here or not, but now we'll yank your ticket. You will be unable to prepare returns if you're if you're not willing to work with our tax department to just answer a couple of simple questions. That's what will happen.
So their view is, if my only office is, I don't know, Woodbridge, New Jersey, and I live in Edison, New Jersey, and I never leave New Jersey, but some of my clients have New York returns, resident, non-resident, that I'm doing business in New York?
No, just being in New Jersey and staying in New Jersey does not cause you any New York tax problem. However, you are practicing accountancy through the mail into New York. You are filing in Albany for your clients, and yet you're unwilling to have anyone talk to you about what you do. That's going to cause some scrutiny.
In New York City, you come after you too.
Yeah, yeah.
And the other issue that can come up is, yes, you can, I guess, ignore a letter from the state, but the New York Tax Authority has a general rule that says, look, we're going to send you a letter. If you don't respond to it, we'll ask you. We'll ask you again. We're not going to ask you a third time. The third time, it's possible that you get a subpoena.
And by the way, let me tell you what New York has been doing lately in a situation where people don't want to work with them. So if I was your auditor and I sent you the letter and you said, well, I'm going to pull your cell phone records, which I have every right to do. You won't even know that I've subpoenaed them. I will subpoena your cell records, and I will know your whereabouts, sir, every minute of every day. Whenever you've made a call, received a text, downloaded data, watched a pay-per-view, whatever you've done, I'm going to know about it. And if I see you only in, as you said, on the weekends, you probably got nothing to worry about. But if during the workday, when I as an auditor work, so generally we're talking about 9 till 1, Monday through Thursday. This is taped.
Yes.
It is. Well, actually, there's a story, and I don't know if it's true, but there was a question. This kid went to school and told his friends, my dad is fast. My dad can run the 100-yard dash in 5 seconds flat. And one of his buddies said, that's not fast. My dad is fast. My dad shoots an arrow into the sky, and he can run to the other end of the field and catch it before it lands. That's fast. And the third kid said, you got nothing on my dad. My dad works for the New York State Department of Taxation and Finance. Every day he goes to work from 9 to 5, and every day he's home by 3. That's fast. So anyway, I'd subpoena for your phone records.
I did get a call just before I came here from the New York State Auditor, just on acknowledged on resident, just on the days in, and she told me they were closing the case, no change, and she was almost in tears when she said that.
Yeah, actually, they have a lot of times when they audit very wealthy people, they have to put towels down because they salivate when they get real excited about the potential there. Anywho, see, Joe, 5 minutes in, we're still haven't started slide 1. So as a result of the federal tax law, the Tax Cuts and Jobs Act, TCJA, we're really hurt here in the Northeast, where we've got state and local income taxes that are now limited to a $10,000 deduction with your property taxes. And that's making things very difficult and expensive for many of our taxpayers. And it's making states like Florida or Texas, Alaska, Wyoming, Tennessee, New Hampshire, it's making those states a lot more interesting. Because if you take a look at your outline, you'll see that if you've got somebody, I don't know, let's assume you've got a single person in New Jersey making $1 million a year. Their taxes are going to go up by almost $14,000, which, is not a huge amount, but that same person in Florida would have their taxes going down by $15,000. So it's not a $13,000 or $14,000 switch, it's a $30,000 swing. And obviously it gets real expensive when you get into the $5 and $10 million stratosphere. But even somebody making, making 500 grand, not a huge amount, is still hurt to the tune of $7,000 versus Florida, where they're ahead $5,000. So even there, it's costing more money. And as a result, states are trying to come up with ways of defeating this kind of stuff. In New York City, for example, an average family will pay 25% of their income in taxes. In Florida, that same family will pay just 14%. So it just highlights the difference. And it means that a lot of our clients who have historically been happy or at least comfortable living in New York or New Jersey or Connecticut are now starting to think, gee, when I start to eat into my 401k, which is taxable, or I take my pension, which generally is taxable, or when I retire and want to have more cash available for my investments, they're really thinking hard now about moving to a low or no tax state. Now, as far as what New York did, New York's Governor Cuomo was aghast at this federal legislation. It's caused a lot of problems and will cause even more problems for New Yorkers. So the first thing we've done is we've decoupled for 2018 from all itemized deductions. So if you look at your Schedule A for 2017, that's the same schedule you will have for 2018 in New York. Obviously, the feds have changed it dramatically. A couple of things that are hugely important to New Yorkers and New Jerseyans: real estate taxes, they are now unlimited, just as they are under your Schedule A for 2017. No limitation there. Itemized deductions, including worker costs, which is a miscellaneous deduction with a 2% floor. That's a real issue with folks who live here in New Jersey or in New York who work in television, who work in theater, who work in movies. Those folks, you work on a soap opera in New York City. You're making maybe $1 million a year, but every actor, actress, director, they all have agents. And these agents get 25-30% of their income. That's what the agent charges. So even though I make $1 million a year, my paycheck is $800,000 a year, because the first 200 goes to my agent. Well, my agent is no longer deductible for federal purposes. Obviously, it exceeds 2% of my income, but now I'm going to pay tax at the federal level on the full $1 million, even though I walk away with 800. We're not going to let that happen. New York considers itself one of the hubs of entertainment, and therefore we have changed it so that we've decoupled, and miscellaneous itemized deductions are allowed, again, subject to the 2% floor, just like the rules on December 31st of 2007. Sir?
But we still have the high-income phase-outs, so that the high-income taxpayers end up getting 50% of contributions and nothing else.
Correct, and if you've got an ultra-high net worth taxpayer, you wind up with 25% of your contributions, which is also...
standard deduction.
Which is, yeah, or the standard, right, exactly, the standard deduction. So New York has decoupled from that. Now, New York has had a rule that most states have. If you itemize for federal, you must itemize for state. If you don't itemize for federal, you can't itemize for state. That rule's gone. Now, because the federal standard deduction has gone up so much, New York has once again decoupled. Therefore, even if you take the federal standard deduction, you can still itemize in New York. Alimony and moving expenses are still deductible in New York. They are above the line items. There's an interesting disconnect right now because for federal purposes, alimony used to be deductible to the payor and income to the payee, to the recipient, right? That's out the window under the federal law.
Not for 18.
Not for 18,
for 19.
For 19, yeah.
For 19, and only new ones, not
Only new divorces.
Right.
So I guess that's the lesson, right? Just divorce quickly, at least before the end of 18, if you want to ensure the deduction.
Or kill them and you can get less jail time.
Or kill them and get less jail time.
Only in Jersey.
Whoa, this is a New Jersey crowd.
Do it in the tunnel.
I told you.
Oh, that's wonderful.
You can always tell where we are. New York has 1 year to audit amended returns. It used to be if you filed an amended return, you were left with the original statute of limitations, so a lot of people would file an amended return a day before the statute would run. They'd try to get their refund, and New York is still audited, but they could never assess an additional penny. Now New York gives itself an extra year. New York allows an Empire State Child Credit. It had been up to 33% of the federal child credit. But as you may know, the federal child credit has doubled. And that would be very expensive for New York to continue to follow 1/3. So therefore, we are back to 2017, and we are limiting the federal amount to $1,000 so that our statute, which says you get 1/3 of it, stays at $333. Obviously, the 20% deduction is a big deal, not in New York. New York starts with federal AGI. Federal AGI is computed before you take the deduction under Section 199A, that 20% federal deduction. And so New York has no impact, or no impact at all in New York with respect to 199A. New York has also extended, question? No. Oh. New York has also extended its credits for musical theater, hiring a veteran, and historic rehabilitation. New York is going to make a whole bunch of money on some of the corporate tax changes, because the biggest thing that happened on the federal side is that tax rates went down. But New York doesn't tie itself to federal tax rates. We tie ourselves to taxable income when it comes to businesses. And taxable incomes are going to take a real big hit, not the least of which is because the business interest deduction is now limited to 30% of a taxpayer's adjusted taxable income. So on the business side, this is going to be a real big plus for New York. We are going to follow it, and it's going to mean $45 million of additional cash in New York's pocket. New York has also reversed the Sabatka rule. What is the Sabatka rule? Well, Sabatka is a case that came out a couple of years ago that says this. New York, like New Jersey, has different rules with respect to residency, right? If you live in New York, you pay tax. But what if you live in New Jersey and you commute to New York? Well, if you commute to New York more than 183 days and you keep an abode there, you got problems. You've got New York State, potentially New York City, taxes on everything. And that's a real issue. The Sabatka case says this. What if I move out of New York today? I move out and I move to Florida with my family. I've got my Google stock and I'm going to sell it after I put the kids in school in September. I'm leaving. I am never coming back to New York other than next summer I'm going to come back for 2 weeks to stay in the place and fish. That's it. What happens? Well, most people think you go down to Florida, make sure the kids are enrolled, you're really a Floridian, the moving van, everything. It won't matter because the statutory resident rule is a calendar year rule. So the question is, as we sit here today on August 29th, my goodness, where did August go? On August 29th, have I been here more than 183 days in New York? You bet. That happened somewhere in July. I didn't travel that much. Well, do I have living quarters available to me all year long in New York? I do. So I'm incapable of changing my tax residence this year. If I sell my Google stock in November, I'm a New Yorker. Even though I think of myself as a Floridian, I've moved to Florida. Sabatka says not so fast. Sabatka says the 183-day rule only applies to non-residents. So Mark Klein was a resident until August of 2018. So August of 2018, I'm a resident, I pay tax on everything. So the question is, from August 29th until the end of the year, was I in New York more than 183 days? No, it's not possible. There aren't 183 days. Sabatka says I win. Sabatka says that statutory residence doesn't trump domicile. New York doesn't like that rule. The auditors are very upset. They tried to pass legislation retroactive to get rid of Sabatka. They were unsuccessful. It is only effective January 1st of 19. But starting the beginning of next year, if you've got somebody who is physically in the state more than 183, by the time you get to a day like today, it's too late to change your tax residence. New York allows its college choice plan, 529 plan. As you know, the federal government, as part of the Tax Act, allows deductions from a 529 plan now for K through 12. New York does not. Now you might say, isn't New York's 529 plan somehow based on the Internal Revenue Code section 529? True. And isn't New York's 529 plan the same as the IRS 529 plan? Sure. And haven't they changed section 529 to allow contributions between K through 12? Yes. Then how can New York decouple? One word: unions. We have very strong teachers' unions in New York. Our governor, did I mention he wants to move to Washington someday? He is not going to tick off the unions. And the unions do not like charter schools. They don't like this. They don't want people putting money aside for yeshivas. And therefore, the governor has decided, at least to date, that we are not going to follow the federal law on 529 plans. What else? Any other federal tax law change other than what we've just discussed will flow through to New York. So as you go through the TCJA, everything else follows. New York is now allowing restaurants and caterers to buy food for resale. You might think that's awful silly, since of course if a caterer buys food, they're going to resell it. But for some reason we had a glitch in our law that said a caterer had to pay tax when they bought the food. Then when they sold it, they would collect tax and take a credit for the tax that they had just paid. It seemed silly. It was putting a lot of businesses in stress because I'm a restaurant. I sell the caterer food and I don't collect tax because I know he's reselling it. And yet, I have to have collected tax. I'm on the hook. The fact that he gets a credit is interesting, but it's not my credit. It's his, the purchaser. So we were seeing people really get squeezed as a result of this misunderstanding of the law. This will change that. New York has also now exempted drugs and medicines used by vets and farmers effective a couple of months ago. And we have finally passed some legislation to partially help people who are members of an LLC from a sales tax problem. Here's the problem. In New York, like most states, sales taxes are a trust fund, right? If I sell you this clicker for $10 and I collect $10.80, those 80 cents, the sales tax, better find their way to Governor Murphy, or you could be personally on the hook. In New York, we've got the exact same rule. It is a trust fund. New York goes even further. New York says if I forgot to collect the tax, it's a trust fund. New York also says if I bought it and didn't pay tax, that's a trust fund. And the problem we have in New York is that the responsible people represent those who hire and fire, who sign checks, who sign tax returns, people who are responsible for the finances of the business. Kind of makes sense. The whole idea of the law is to motivate people who are in some position of control and power to pay the sales tax, not to keep it or divert it. But there's something wrong. In New York, we impose this liability on all partners of a partnership. And that kind of makes sense. Partners are responsible for everything. But what about members of an LLC or an LLP? Under New York law, they are treated like partners. Therefore, the following situation came into my office a couple of years ago. I represented a Hollywood celebrity, a name you would know. He invested $100,000 in a restaurant in New York City. He came into New York City that night of the opening, had a wonderful time, celebrated, champagne, the whole bit, and he went home to California and never came back. He owned 10% for his $100,000. Turned out the restaurant promptly circled and went right down the drain. And by the time they were done, they owed $4 million worth of sales tax. Yeah, they were really effective, very, very good. They were working hard. And my client got a bill for $4 million. My client, who had no signatory authority, didn't sign checks, didn't file return, he had nothing. He's a limited partner. He's a 10% partner. He paid $100,000, and now he's on the hook for $4 million. So New York says that's probably a little overboard. So it's not a solution. So now New York says, well, look, if you own less than 50% of the LLC or LLP or whatever it is, and you weren't responsible, you didn't, none of the normal indicia, because if you were a normal person who was responsible, all bets are off. You owe everything. But assuming you're under 50% and you have no financial responsibility for the business, we'll only hit you with your percentage ownership in the entity. So my guy who owned 10% will be on the hook for $400,000. And you might say he invested $100 and now he owes $400. How is that fair? It isn't. But we can't give away that much money. And from the person's standpoint, $400,000 is probably better than $4 million. So that's New York's fix of that issue. It certainly is not a solution. Speaking of things that aren't solutions, yes, sir.
It's the vodka rule that was repealed. It's because I moved to Florida today, but I keep the house in East Hampton. But
Yep.
if I sell it or rent it out, then I'm okay.
Correct. The question for statutory residents is, number one, during the calendar year, were you in New York more than 183 days? If the answer to that is yes, did you maintain living quarters for more than 11 months? And it's usually, there are some games people try to play with the 11-month rule. You can't rent it out 1 month a year. But generally speaking, did you have the place available for more than 11 months? So yes, if you move out and sell it tomorrow, or sell it in September, or October, or November, you're good to go. Similarly, if you rent it to a third party. But if you keep the place available because next summer you want to come back, which was my example, you're cooked. What else? That was Sabatka. So speaking of solutions or attempts at solutions, New York is trying to ameliorate the impact of the Tax Cuts and Jobs Act on New Yorkers because of the disproportionate burden that we are going to all have to assume because of the limitation of the state and local tax deduction. I mean, that was the biggest deduction for most New Yorkers. And of course, interesting that New York says it's unconstitutional to take away that deduction, given that New York never allowed the deduction, right? You always had to add it back. But in any event, it makes for good politics, I guess. So New York has a rule that says if you want to participate in this program and you're an employer, you can decide for all of your employees making more than 40 grand a year that we will impose a tax on the employer. The employer, it phases in over the next 3 years. It's a 1.5% next year, 3% in 2020, 5% in 2021. But by December 1st, the employer makes an election, and the election says we, the employer, are going to pay whatever the percentage is that year and put that aside and pay that to New York State as a withholding tax on the employer, which is fully deductible, and give a credit to the employee of the same amount. So you think to yourself, aha, eureka, how is this supposed to work? Well, currently, the employer pays the employee 100 grand. The employee pays 5% or so to New York State. So at the end of the day, the employee walks home with 95 bucks. Under the new law, the employer pays $95. It pays another 5% to New York State. So in effect, the employer has paid $100, just 95 to the employee and 5 to New York State. So the employer still pays the full 100. The state of New York still gets the 5. The employee still gets the 95. Everybody's happy, and the federal government gets kind of screwed. Hooray. Except I know of more than 100 of my clients who have investigated the possibility of doing this, and the total client base that is taking advantage of it, starting in 2019, carry the one, 0. Nobody. Why? It's, if you speak Yiddish, mashugana. It's crazy. Why? Number one, how do you explain to the employee that you got to have your salary reduced to 95 bucks? Trust me, I'm your employer. This will work out better for you. And by the way, you can't reduce their salary by this. You have to get an agreement with the employee to just take less money. What about employees that have contracts? What about unions? What about the fact that my 401k match is based on what I make? Now I make less. Social Security, same idea. My base has just gone down. What about a New Jerseyan? What if a New York company were to make this election and your client commutes in from New Jersey, winds up getting only 95 bucks because the $5 is paid by the employer, and at the end of the year, the employer pays, 20 grand on behalf of this New Jersey employee. 20 grand gets paid to New York. In New Jersey, as you know, you start with 100% of your income. What is the New Jersey tax? Less a credit for taxes paid to other states. What tax did he pay to another state? 0. His employer paid a tax. Can this non-New Yorker, can this New Jersey resident take a credit on his New Jersey tax return for taxes paid by his employer? No way. This is a disaster. And by the way, even after it's fully phased in at 5%, the maximum amount that the employer can defer or pay to New York, the savings is about $18,000 per million of comp. That's when it's fully phased in. This year, or not this year, you know, the election that you'll make in 2018 for 2019, where it's 1.5%, for every million of compensation, you will save almost $4,500. And the employer's got to go through all of this mishigas, all of this stuff, which, again, absolutely nobody is taking advantage of.
What schmuck thought of it?
The schmuck that's going to run for the White House. Oh gosh, are we taped? No, and I can't get political. I'm not going there. What else? New York also has this great charitable contribution. You may have read about this the other day because the IRS is issuing proposed guidance that took effect, coincidentally, just yesterday.
Yeah, 3 days.
So, you had 4 days. You had 4 days, and it still doesn't work, from my standpoint. So here's what happens. We've got new charities in New York. We've got charities where if you pay, at least according to the governor, if you pay $100 into a charity or $100,000, you're going to wind up not only with the $100,000 deductible, because it's a charitable contribution, we're going to get you the deduction on the state side, deduction on the federal side, and 85% of it can be used against your taxes for New York State next year. So the math is phenomenal. You pay $100,000, your tax savings is $37,000. Your New York tax savings could be as high as $88,000, maybe not because of the limitation of itemized deductions. So your benefit is $45,000, and that's the old rule as well, right? You get the deductions, it's worth $45,000 out of pocket. New York gives you $85,000 of credit, so your $100,000 contribution gets you $130,000 worth of benefits. That's a 30% return. That's fantastic, if only it worked, but it doesn't. Number one, I know that when I go to a charitable dinner, it often costs me and my wife $100 per plate to go to this charitable dinner. And when I get a letter back from the charity for my $200 contribution, it says $25 for the stupid rubber chicken, which by the way is crazy. It's not worth $25. So I get a letter saying it's $75 of a deduction or donation. Why? Because I got something of value, if you consider the rubber chicken value. I got chicken for part of my money. Well, here, how can you possibly say that you are not going to pay your income taxes, you're going to get a credit for the taxes used for fire, police, road paving, and instead you're going to give it to a charity that will provide fire and police and road paving, the exact same services. And of course here it's dollar for dollar practically. So what the IRS said last week is, look, when everybody gets a benefit from charity. We get that. If you give $100 to charity, you could very well save $37 on your taxes. And that's okay. But when it's dollar for dollar, when it's $25 worth of chicken, we're not going to allow that. So what the IRS has said is we'll give you a 15% deduction because you're only getting 85% back. But at 15%, it doesn't make any sense to do this because you're going to pay $100,000. You're going to get a deduction of if you're going to get a deduction of $15,000, right, which is worth maybe $5,000, and you're going to get $85,000 worth of credit for a total of $90,000. So for all of your $100,000, you'll get $90,000 worth of benefit. Not the best investment in the world. If you would like to spend $100,000, I will personally return 90 to you if you would like and save the middleman, anybody who wants it. So this is a mess. No one that I know of is going to take advantage of this now. They also have a local version, interestingly. The local version lets you take a 95% credit on your real property tax bill in New York. But once again, the IRS has said no. We will give you 5% as a deduction because the other 95 you're getting a dollar for dollar benefit. So as you can see, there's some news articles here that basically say this does not work. I was quoted in Bloomberg where they asked me, does this turn a tax into a charitable contribution? And my response was, calling an alligator a hairless, toothy, non-barking dog doesn't make it so. So as you can tell, I'm not a huge fan. And I think that anybody who invests $100,000 in this should fully expect to be limited to $90,000 in return. Now here's an interesting idea that New York is thinking about that may have legs. Connecticut just did this. New York is thinking about having an unincorporated business tax on partnerships, LLCs, LLPs, etc. Now, this is similar to the UBT we have in New York City, but this would be at the state level. And basically, it would be a 5% tax at the entity level, at the LLC level, at the partnership level. And so the LLC would pay a 5% tax on its profits. Now it pays nothing, right? The shareholder partners members will get their share on their K1 of the taxes paid by the entity. That will flow through to them. And New York will give them a credit, of course, for the taxes paid to New York State, or maybe 93% of it. That probably works. Now again, it doesn't exist yet, but they are studying it. Right now, we think that this is probably the best deal you're going to see. It allows the entity to pay the income tax. It allows the shareholder members to get a 93% of the income tax. So this will solve a little bit of the problem. Connecticut, same thing here, it's almost a 7% entity level tax. Same issue though for New Jerseyans. If I am a New Jerseyan, will New Jersey give me a credit for the tax paid by my LLC that passes through to me as a state tax?
Are you saying a credit or a deduction?
Well, New Jersey should give you a credit, should it not? Oh, did I say deduction?
No.
Oh, yeah, it should give you a credit, right? You get a credit for taxes paid. Will New Jersey allow that because the shareholder member didn't pay the tax, their entity did? They probably should. I think they would. I know that when my law firm pays other states, I get a share of that credit on my tax return.
But that's a composite non-resident partner tax.
Yeah, you're right.
This is an entity.
It's an entity level tax.
So there's a distinction.
You don't think they'll give it to you?
No.
Yeah.
Unless it's a line item in the K1.
If it's I don't know that it matters where it's reported though, right? The issue is, does a New Jersey resident get a credit for taxes paid not by the resident, but by their entity? I think it's a tough one. I think.
I don't think so.
Yeah. So anyway, that's going to be a mess, but not for me because I I'm not a New Jersey resident, so I'm good to go. Which is really, if you think about it, what really counts. What else has happened? What didn't pass in New York? New York has a couple of things going on. Number one, I'm sure you're familiar with the South Dakota v. Wayfair case. It's the big case that came out of the Supreme Court of the United States that says, forget what you knew about sales tax nexus. What is nexus? Nexus is just a fancy way of saying connection. It's a way of saying, does a New Jersey vendor who has nothing but New Jersey connections have an obligation to collect the tax for South Dakota because it happens to sell stuff there? And the answer is, yeah. Starting from South Dakota already, other states are catching on to the bandwagon. Basically, if you've got $100,000 or more, or 200 transactions, either one, into a state, you're going to have an issue. Now, what New York and New Jersey and other states are wrestling with is, it's great news. We're going to have tens of thousands of additional registrants. Everybody who sells on Etsy, everybody who sells on eBay, everybody who sells on Hotels.com, everybody who sells on FBA, Fulfillment by Amazon. It's the Amazon, they let you sell your own stuff on Amazon site. We're going to get tens of thousands of new sales tax collectors, except no system is ready for this. They don't want tens and tens and tens of thousands of new registrants. We don't have the capability in New York to handle it. So what we've done is proposed legislation, you're going to see this throughout the country, called marketplace legislation. Marketplace legislation says that we're going to put the burden on eBay, on Amazon, on Hotels.com. Now you might say, why doesn't it already apply? Because eBay doesn't sell anything. eBay has no inventory. Hotels.com doesn't own a single hotel room. eBay is simply finding willing sellers and matching them up with willing buyers and taking a commission when those guys do their thing. So eBay gets to say, don't look at me, I didn't sell anything, I just took a commission as a broker. Well, the states are now going to impose on the marketplace. It's a lot easier to have one eBay register than 5,000 sellers on eBay. So you're going to see this so that when eBay issues the bill, it includes sales tax. That did not go through. New York lost the battle to get that through, but you're going to see that tried again. What else? The best deal in New York continues to be the 1031 Likekind Exchange. I can have a building in New York City. I bought it when it was worth nothing because of New York City's infrastructure, because of the police, because of the fire, because of the roads. That building is now worth $20 million. All of the taxes that went into making that building worth what it's worth. And now I'm going to cash out and get my $20 million. I'm obviously going to have to pay New York State tax. I'm going to pay New York City tax. But it seems only right since they were the reason it's worth what it's worth. But here's what I'll do. I'll do a like-kind exchange with a similar building in Florida. And maybe if I'm smart, I'll move to Florida. And then about a year and a half later, I'm going to sell the building for the same $10 million it was worth. It never appreciated a penny in Florida. Well, what happens from a tax standpoint? In year one, New York will tax me based on my federal AGI. When I've got a like-kind exchange, how much goes into my federal AGI? 0. So I've got no gain in year one. In year two, I am a Floridian selling property in Florida. New York can tax nothing. And this is kind of crazy because the feds would never let you do this. 1031 isn't supposed to be an exemption. It's supposed to be a deferral. What if I said I'm going to sell the New York City building and do a like-kind exchange with the London, England building? Doesn't work. The feds would never get their money. Even California doesn't let you do this. If you transfer and get property outside of California, you better post a bond for the tax you should have paid. Meanwhile, New York lets you do it. It's kind of awesome. Federal sub-S conformity. The governor in his last budget bill, oh my goodness. The governor in his last budget bill said, we're going to start taxing S corporations that are for federal purposes as S corporation for New York purposes. Currently, we allow hybrids. You can be a federal S and a New York C. And why would you want to do such a thing? Well, let's say, for example, I'm a Floridian. I would prefer to get my money out of my corporation as a dividend. Otherwise, it would come as earned income. So it's not really going to matter to me from a federal standpoint. Maybe I'll have some FICA on it. But boy, if I can have it paid out as a dividend, I don't pay any state tax at all. No state tax whatsoever. Because Floridians don't pay tax on dividends. So the only beneficiaries of this, though, are non-residents. If I'm a New Yorker and I get a dividend, I pay tax at the same rate. We don't care about the rates. There's no capital gains in New York. If I'm a resident, I pay tax on everything. So the only folks who benefit from this are non-residents. And as I mentioned at the outset, we don't have a lot of love for non-residents. We would like to take more of their taxes because they don't vote. So I think you're going to see the governor try this one again in March of next year by eliminating hybrid S corporations. We also, the governor wanted the right to appeal tax appeals tribunal decisions. Our tax appeals tribunal is the highest jurisdictional body, adjudicative body in New York, and that went down in flames as well. So that's kind of an overview of what's happened this year and some of the new legislation as well as legislation that didn't pass. I'm going to let my partner, Joe Enders, talk to you about some new developments in the sales tax area. Do you answer these questions, by the way?
I do.
All righty.
You have to take off the tie, though.
Tie and jacket.
I'll be back.
Yeah, well, we're going to switch back.
And the one person who applied. He's got the. It's hot out here.
I'm good. Well, good afternoon, everyone. Thanks for having us here today. I'm going to talk about sales tax because sales tax is by far my favorite tax.
You're boring.
I was just going to say.
How were you able to learn that already? It usually takes people 5 minutes to come to that conclusion.
I realize I'm going to lose half the room just by saying that. I get it. But no, it is by far the best tax because it's the meanest tax. I mean, the slightest factual difference can cause a transaction from being non-taxable to taxable. That's kind of the point of this slide. slightest factual differences go from having a perfectly easy, no problem audit to a huge liability for the company that, because sales tax is so mean, the owners of the business might be on the hook personally for. Again, the meanest tax. So what is this? Again, this slide is really just about, are your cookies warm? Well, in New York generally doesn't tax baked goods like most states. Cookies are considered baked goods and are usually non-taxable. But there was an advisory opinion that came out last year that asked, well, wait a minute. We have a business that gives you warm cookies. Everybody loves a warm chocolate chip cookie. Most of their business, people would come in and eat at the shop, get a 1 or 2 warm cookies. But they also had a takeout window, like a donut shop. You know, you can drive up, get some warm cookies, take them home. Or you can order through the app and have them delivered to you, warm cookies. And the question was, well, look, cookies aren't subject to tax, right? In New York, there's a lot of baked goods aren't subject to tax. Wrong. These are now, because they're heated, considered prepared food, which is 100% subject to tax. So just because they added some heat to these cookies, this business that went from something that is totally non-taxable went to something completely 100% taxable. Similar thing with hairstyling. Again, where are you? You just got to know the
Don't
rules.
ask me.
Trump is combing it.
Well, if Trump gets it combed in New York City, that's subject to sales tax.
So that's why he stays in Washington.
That's right. Now, if he came to my neck of the woods out in Buffalo and he got his hair cut, that's not subject to sales tax. It's just by virtue of that geographic location. And it's not just hair cutting. It's, you get hair implants, or you get, a weave, or you get anything really kind of that's done by a beautician. All of that is taxable if you're in New York City. But there's another little factual twist. Doctors who actually do hair restoration, you get it done by a doctor, not subject to tax. So it's, again, what is taxable, what isn't? Home inspections. I love this one. A home inspection, if I'm going to go buy a home and I want to know, is there anything terrible? Is the foundation crumbling? Is there asbestos in the walls? I want to know before I buy this property, is that subject to tax? The answer is no, not taxable. It's just an information service that, even though New York taxes information service, it's personal to me, they let it slide. However, what if I own the building already and I decide, look, I'm looking to sell the business, I want to know kind of what's the value of the building, what it's worth, are there any dead bodies in the walls, or something terrible that I have to worry about? I'm
Again,
in
it's a New Jersey
I'm in
reference.
Jersey, I'm in the audience. So is there anything that I need to worry about? Well, now that exact same report that tells me whether or not my business has, the walls have something terrible in them, that report becomes taxable. Because reports for the actual owner of the business or of the building are considered maintenance. That's what you need to do to maintain the building. You got to know what's in it. And New York takes the position that that's taxable. So again, exclusively by virtue of who asks. And there are a million of these. My favorite one is, a month before Halloween a few years back, New York issued a bulletin that says, hey, are pumpkins subject to tax? Again, this is right before Halloween. Now, like I said, groceries, baked goods, stuff like that, generally not subject to tax. And a pumpkin, you can make a pie out of, you can bake stuff with it, make pumpkin bread.
You could throw it.
But you
Again,
can also,
you're in New Jersey.
Right, exactly. I'm glad there's no fruit. So is a pumpkin subject to tax? Well, if it's sold as a pumpkin and you're going to bake with it, yeah, it's not subject to tax. But you can also carve it and put it out on your front step and have a decoration for Halloween. And that's just any other tangible property. Is that subject to tax? So the question is, again, how do you treat pumpkins?
How are they gonna know?
Does anybody know the answer?
They drive by your house.
They drive by your house. I wouldn't put it past them. The answer is this. They expect the
You paint
person...
the face on it, it's taxable.
Yeah.
That is true.
So here's how the tax department splits that baby. They expect the person selling the pumpkin to know which breeds of pumpkin are good for eating, in which case the sale of those are not subject to tax, and which breeds of pumpkin are not good for eating, in which case the only thing they're being sold for is as decorations, and they're subject to tax.
The other way they tried to resolve it was by having the farmer look you in the eye and say, what do you plan to do with this pumpkin? But too many farmers were injured in asking that question, so they went back to the breeding.
I thought it only had to do with sheep.
I'm going to get the last little innocent thing. Moving on. Again, right before Easter, Peeps. Are Peeps subject to tax? Peeps, those little chick, marshmallow things? Well, marshmallows are just a baking ingredient, right? Not subject to tax. Peeps are just specifically shaped marshmallows with a little sprinkling on them. Is that subject to tax? Well, again, right before Easter, the tax department says marshmallows, baked goods, no problem. Peeps are candy, and candy is subject to tax in New York. So again, these slight factual differences, and there's a billion of them. We can do this all day. But that's the difference between a taxable product and a non-taxable product. And if you're not charging tax because you don't think what you're selling is taxable, when the audit comes, you're going to be hit with a huge bill. And again, sales tax is not meant to be a liability for the business. Right? You're supposed to charge your customers it. It's the taxes on the customer. You're just a conduit to get the money to the state. But in these situations, when you don't know what you're selling is taxable, the business ends up getting hit with it. Okay? Now, there are provisions under the tax law that allow you to go back to your customer to charge them the tax. But good luck going back to all the people that bought Peeps to charge the 8 cents or whatever it is. Okay. So part of what I wanted to do today, this is part of a much bigger kind of presentation. I wanted to highlight the areas where New York has unusual rules, especially in comparison to the rules here in New Jersey. Okay, so and one of the biggest places that we see different treatment is with respect to what I call technology transactions, cloud computing, transactions that use the internet in some capacity. Okay, the best way for me to describe this is to give you an example. We're going to be coming into tax season after the holidays, and let's say I decide I've got to do my taxes, right? Now I have 2 options. I can hire one of you guys to do my taxes, in which case in New York and in most states is a professional service, not subject to tax, right? Or I can try to do my own taxes. And if I take that approach, I'm going to maybe buy some software to help me do it, right? Now, if I go to a Best Buy and I get a disc like people used to do and put it on my computer and I buy that software, is that subject to tax?
Yes.
Yes, in both New Jersey and New York. Absolutely. That's just taking software, buying it, putting it on your computer, and you have a copy of it. But nobody does business like that anymore, right? Nobody goes to Best Buy to buy software. Now what happens? Well, now what most things do is, TurboTax, you can use it online. Or you can just electronically download a version of it if you want to. Right? So now everything is done in the cloud, transferred electronically. So let's ask this question. If I contact TurboTax, I download a copy of that software onto my computer, is that subject to tax? It's pretty much a similar transaction as me going to Best Buy and get it, but the only difference is how I got it onto my computer.
In Jersey, no.
That's correct. Well,
No,
it's
it's not business use.
Right, so that's the question in New Jersey. If you electronically transfer something in Jersey, if it's used, and remember, exclusively for business, if you let 1 or 2 employees start using the software for personal reasons, that invalidates the exemption, and you can get charged tax on this. But if it's used exclusively for business, when it's downloaded electronically, it's not taxable in Jersey. What about New York? Still totally taxable. Doesn't matter if you downloaded it electronically, if there's no physical product. Even though the provision that's taxing it is a tax on tangible personal property, they consider software tangible personal property, even if it's downloaded over the internet and you can't see, touch, feel, taste, smell, whatever. Anyway, so that's one of the differences. Another difference, let's kind of move it forward a little bit in terms of technology and say, you're not going to download anything. You're never going to put the software on your own computer. All you're going to do is through an internet interface, your web browser, you're going to access a web portal and use their servers to do all the computing. You'll save it on their servers. You kind of do everything remotely. This is called software as a service. It's remotely accessing software to use on their thing. All you have is your normal web browser. Is that subject to tax? Now there's no software transfer. The answer in New Jersey is no. New Jersey does not tax software as a service. The answer in New York is absolutely. That's 100% taxable. In New York's view, that is considered a license to use software. It doesn't matter that it was never actually transferred. That's a license to use software. You can get the exact same result. You can get the benefit of using the software, even though it's sitting on a server somewhere and not on your computer. So again, that's a huge difference between software treatment in Jersey and software treatment in New York. Information services. New York taxes information services. And there were these kind of really interesting cases, Retail Data and Wegmans. It's these cases where Wegmans is one of the greatest New York businesses ever. You guys have Wegmans here?
Yes.
Yes, okay, great. So I started in Rochester, right? Yep. So Rochester business, the best grocery stores ever, right? They're wonderful. But Wegmans is also very competitive, and they hired this business, Retail Data, to go out and shop their competitors. Basically create a list of items that Wegmans was selling and what their competitors were selling, and let me know the price difference. And that allowed Wegmans to kind of target where it wanted its specials, its sales, its coupons, whatever. So they basically did price comparison shopping. And the question was that information that they got from that comparison shopping, was that subject to tax? Because New York taxes canned information. You know, information that comes from a common source, information like this is the stock history of this price this is the price history of this stock. You know, any type of certain news clippings, etc. Those type of things can be subject to tax. It's just taxable canned information. So what was that? You know, the price shopping.
That's specific.
That's what Wegmans said. Wegmans said, well, that's specific. That's not information. The tax department said, no, that's information. And what controls this analysis is the nature of the database that it comes from. Here, the database is common. It's open to everybody. It's essentially canned information. It's information that's available to everybody. So they just went and shopped around and pulled the information. But it still comes from a common source. It's not personal, confidential, etc. So the tax department takes the position it's taxable information. There's a huge fight, goes up the courts, and ultimately, Wegmans wins, at least as of right now. Wegmans lost at audit, I think lost at the ALJ, and then won at, lost at the tribunal and then won at the third department. So this has been going, there's been 3 trials, essentially, and now it's going to New York's highest court, okay? Asking whether or not this is a taxable information service or a non-taxable kind of price checking service. One of the other things I want to mention is bulk sales rules. New York is somewhat of a unique state, especially as compared to Jersey. When I buy a business, when you buy the business, you think, okay, well, if I buy the stock in that business, I'm buying that business, my law school professor used to say, warts and all. Right? When you buy the stock of a business, you're buying the actual business, all the bodies that are buried, everything that is negative about that business is coming with it. I mean, it still exists. The entity still exists, right? As a result, most people who buy a business, most buyers, want to buy assets. They get the benefit of that limited liability in terms of the transfer. There's also other tax reasons for doing an asset purchase. But most buyers want an asset purchase. But be careful. New York is one of the few states that allows transfer liability to the purchaser. Well, what does that mean? Well, most states allow what's called an occasional or isolated sales rule. I believe New Jersey has one. But it basically says, most states take the position that, look, when you sell something that you're not usually in the business of selling, that's not a normal transaction. That's isolated, it's occasional, there's not going to be any tax on that. When I sell, I'm in the business, Wegmans is in the business of selling groceries, right? They're not in the business of selling all of their computers, all their cash registers, all their gondolas, all the shelving. That's an isolated or occasional sale. So that when they sell that, there's usually an exemption for that type of transaction. Well, New York says, 1, we don't have an exemption for that. All of that sale is going to be subject to tax. And 2, unless you let us know about it, that asset purchase, the buyer can become liable for the seller's sales tax liabilities. Transferee liability. Basically, anything that the seller did wrong, if you don't get the state involved and file this bulk sale notice, the purchaser is on the hook for it, becomes liable for it. So just be very careful with that in terms of the bulk sale rules at buying an assets. Most businesses think it's the safer way to proceed. In New York, you're going to get successor liability there. Another area where New York is particularly aggressive, contractors. New York puts pretty aggressive rules in place anytime it's dealing with what it considers industries where some gamesmanship might be going on. And contractors they are a group that the New York State Tax Department mistrusts. There's just no other way to put it. Cash businesses, restaurants, bars, contractors, these type of industries, New York really kind of puts the screws to. Well, how do they do that with contractors? Well, most of contractors' purchases are subject to sales tax. Contractors generally in New York aren't allowed, there's a few isolated exclusions, but generally speaking, contractors aren't allowed to buy things for resale because they're not really or they may be reselling them if they're doing a taxable repair, but they're not reselling them in a taxable transaction when you hire a contractor to like build a building. That's a capital improvement, right? Capital improvements, if I'm hired to build a building, not subject to tax. That makes sense. Contractor buys the material, pays tax then, builds the building, doesn't charge tax, but certainly the tax that they paid on their materials is going to be flowed through as an overhead cost, right, when they're bidding out the project. That's how it normally flows. Now, contractors will not, again, buy the purchases for resale, even when what they're doing isn't a capital improvement. You know, sometimes they might just be fixing a window or fixing some shingles on a roof. It's a repair. In which case, that's not capital improvement. It's not capital in nature. That's just maintenance to property, and that's subject to tax. So they have to charge tax on that transaction. But wait a minute, didn't they? You just said you can't buy anything for resale, so doesn't the state get taxed twice? Well, in New York, the answer is no. Contractors can take a credit for tax paid on the materials used in a taxable repair. Again, confusing. It basically requires contractors to pay the money up front and then get it back. That's how it was with caterers and restaurants, but as Mark mentioned, they just changed that rule to allow caterers and restaurants to buy things for resale. Other thing with respect to, yep?
Don't you charge tax on the non-material portion of the contract with repairs?
Yes, so you would charge tax to your customers on the full job.
But only if you separately stated on the invoice.
You would charge tax to your, so let's say you have an invoice that says shingles and hours of labor, right? All of that is going to be subject to tax in New York. You're going to charge the customer tax on the entire bill, those two things added up. But you're going to get a credit for the tax that you paid on the shingles when you first purchased them. Okay, other thing with respect to capital improvements. New York, in order to qualify as a capital improvement, a job has to satisfy 3 requirements. It's got to be permanently affixed to the property, such that removing it would essentially destroy the property. It's got to prolong the useful life or increase the value of the property. And third, it's got to be intended to be permanent. That's the weird one. That's the one that, you know, the first 2 I kind of get. They're usually pretty easy to deal with. It's that intended to be permanent. Well, that's tough. That can be a slippery slope, and here's why. It often comes up when you're dealing with a New York City, build out of a business, a floor. New company comes in, rents the space, wants to do a gut renovation. That's generally speaking a capital improvement. There can be some issues with it where some things aren't, but it's generally a capital improvement. But what if that space is leased? And what if one of the provisions of that space requires that the person doing the capital improvement return the property to its original state when the lease ends? How can you intend to make a capital improvement permanent when you've got to leave the space and return it to its rightful position or former position when you leave? The tax department takes the position that if you have that provision in your leases, it can't be a capital improvement. However, if you have another provision that basically says all improvements transfer to the landlord upon installation or transfer to the landlord at the conclusion of the lease, then you're okay. Then it qualifies as a capital improvement. Again, just one of the things that New York auditors look for to really trip you up on a capital improvement transaction. New York State really kind of putting it to art galleries too. It's, New York changed its rules recently to actually be a little bit more relaxed or more beneficial to what we call luxury purchases, boats, airplanes. So they had to make up that revenue somewhere, and it seems like what they're doing is going after galleries aggressively. Here's what happens. Basically says that, look, if I go to a gallery and I buy a piece of art, painting, or I go to an auction and I buy a work of art, if that gallery ships it to me in New Jersey, I'm buyer, I go to the gallery, I purchase it, I want them to ship it to me in Jersey, that's okay. No sales tax on that transaction. You might have New Jersey use tax, right? You're going to have to pay tax to New Jersey, but you won't have any New York sales tax at all to worry about. What about this? What if, same transaction, except I decide, you know what, I'm gonna use my guy, I got this shipper that I use to move my artwork, I do this all the time, I'm gonna send them in to pick it up and they'll handle the transaction.
Taxable.
Now you're taxable in New York. New York takes the position, you know, sales tax is a transaction tax, and it's a destination tax. What that means is the tax is imposed when the transaction occurs, essentially when the items change hands, and when it's a destination tax in that where it changes hands determines where the tax applies. So New York takes the position that because your guy came in, your agent came in and picked up the material in New York, that's a New York transaction rather than a Jersey transaction. So New York gets the tax. Okay, so it's about paying the tax to the right state. Generally speaking, in sales tax audits, we look at 3 areas: expense, sales, and capital. If you're running a business, and this is why I love sales tax. Sales tax is my favorite tax because it gets you into every industry, right? I don't care if you're an accountant, a lawyer, basically nothing that we sell is subject to tax, right? But we got to pay a boatload of tax on the chairs, the tables, the computers that we buy. So every business, I don't care what type of business, if you're operating, you're going to have tax issues. And so the audits generally look at 3 areas: your sales. Now maybe you're like us and your sales don't have any taxable transactions, which is great. But your expenses, what you buy, your pens, reoccurring expenses, pens, paper, pencils, computers, etc. Capital assets, things you just buy once in a while. Computers can fall into that category, but your bigger ticket purchases. That's what an auditor is going to look at in New York. And with respect to these audits, I just want to mention a few things again where New York has somewhat unique rules. New York is going to send you at the start of an audit a responsible person questionnaire. Okay, this is basically a piece of paper that says, hey, who's running the business? It is a piece of paper that you should take to mean who is New York going to assess personally if this audit results in any type of liability. That's what that questionnaire basically means. Who is going to get a personal assessment? So a couple of things to think about. One, don't give them anything they don't already know, right? I mean, if they're looking for responsible people, it's people that sign tax returns. It's people that are signatories on the accounts. Again, this is all public information or information that the state can get or already has. So be mindful of who's already on the radar, okay? But 2, also keep in mind that when you start an audit, when a business starts an audit, there's a statute of limitations if that business is filing returns, right? In New York, it's 3 years. They got 3.
Jersey is 6.
New Jersey is 6. New York, 3 years to issue an assessment. Now, when that statute runs throughout the audit sometimes can take a year, 2 years. It might push beyond that statute of limitations. And so New York will ask for a waiver, saying, hey, we need more time to complete the audit to issue an assessment. And there can be a question as to whether or not you decide to give that waiver. But I'll tell you, if the auditor hasn't had a reasonable amount of time to conduct the audit and they ask for it and you say no, the next step is to just give you an assessment. And then you're going to have to kind of fight it out either at mediation or in front of a judge saying, well, the auditor's going to say, look, they didn't give me a reasonable time to do the audit. Yes, that might not be the most accurate thing. In fact, it's probably the most aggressive assessment they could possibly come up with. They're probably just going to pull your federal returns, look at your sales figure, and charge tax. That's generally what they do. And obviously that's not right. You're going to have exempt sales. You're going to have sales to other states maybe. There's a whole bunch of reasons why that's not right. But they're going to do that because they didn't have time to conduct the audit. Maybe you want to fight the audit like that. You have to make a strategy decision. But here's the key point on this. If you do decide to sign the waiver, it extends the waiver for the business and the business only. If the state, at the end of this audit, issues a bill and then says, oh, you know what? The company might not be able to pay this liability. We want to go after one of the people, the individuals that were responsible for running the business and issue an assessment to them personally. That's going to be a separate assessment. And the question is, did they get a waiver for those individuals? So when you're answering that questionnaire, you can expect, first, it's important that you're putting them on the state's radar, but 2, they're also going to probably get waivers for those individuals. And to the extent that they don't, there's a separate statute of limitations running for the individual. So you can get out from under an assessment for the individual in certain circumstances. You know, again, if they didn't get the waivers for the separate waivers for the individual. I want to mention penalties and interest in New York because it's ridiculous. Penalties are, you know, they can run the gamut of 25% of the penalty of the underpayment of tax, depending on what they impose. There's a negligence penalty. There's a substantial understatement penalty. There's also a fraud penalty, which equals double the amount of the tax liability. If they decide that there was some gamesmanship going on, and this is the classic case, a lot of our clients, especially Mark's clients, they know enough to collect the tax, they just don't know enough to remit the tax, right? So if that's the situation, that's a very dangerous situation, because New York's saying you knew enough to collect, and then you just pocketed it. And they're not pocketing it. We've all seen this situation where the business starts running, it starts running on hard times, it can't meet all its bills, it's going to start using the sales tax to pay other bills, and then that's just a downward spiral. And that's what ends up happening. But that raises the possibility of a fraud penalty in New York, because you're collecting, not remitting. And if that happens, the fraud penalty is equal to double the tax liability in New York. Double. And if you have any penalties imposed on a sales tax assessment in New York, that's going to double the interest, which is roughly 7.5% normal. That 7.5% goes up to about 14.5% if penalties are on the assessment. So they really hammer you in New York if there's a tax liability.
How much was this $4 million sales tax assessment?
It was $400,000, right? You said 10% you owned?
But the penalty was 100% of $4 million, right?
No, in that case,
it's
it's unlike the federal. It's not an officer penalty. It's an automatic. Whatever the company owed, automatically the officer owes it. So, or the percentage if it's LLC. So that includes interest. It includes penalties. It's unlike the federal.
Yeah. So last point.
Because the federal, it doesn't go, because the interest penalties don't apply.
Correct. In New York, interest and penalties absolutely do.
One last thing that we see in a lot of audits for of businesses operating in New York, a lot of exemption certificate issues. So a business may accept a resale certificate. I'm selling napkins to a restaurant, and the restaurant gives me a resale certificate so they don't have to pay tax. Now that could be a problem. Does a restaurant resell napkins? No, it sells food. It just kind of gives the napkins away for free, right? So there's a lot of issues with respect to the resale certificate, and even if we're talking about something that is clearly bought for resale, like food, they bought chicken that they're going to use in the restaurant. Even there, if the
pet.
What's that?
Maybe it became a pet.
A dead chicken, a frozen chicken.
The chicken make it.
But even if it's that perfectly clear situation, what auditors do is they focus on those exemption certificates and they try to find the slightest problem with them. A date's not on there, a box isn't checked, the address isn't complete, it's more than 90 days after the transaction.
Be careful dealing with non-for-profits.
Yeah, sure, you can, there are certainly, this applies equally to the exemption certificates that you might get for not-for-profits, exempt use certificates too. But the point is that they're going to go through these transactions with a fine-tooth comb because they know that if there's any problem with these certificates, you've just turned a non-taxable transaction into a taxable one. But here's the thing. It's not the exemption certificate that gives the benefit of the exemption, right? The exemption is there in the law. Was this thing resold? If it was resold, then the exemption applies regardless of whether the exemption certificate is timely received or properly completed. The exemption certificate, if it is those things, just acts like a get-out-of-jail-free card, right? You just have to put that in front of the auditor and you say, look, it's not for resale, it's not my fault. I got a properly completed exemption certificate. But if the exemption certificate isn't properly completed or timely received, then you go back to the actual exemption. Was it, in fact, purchased for resale? Was the stuff ultimately sold by your customer? Just keep in mind that it's not the exemption certificate that applies the exemption. That exemption is part of the law. If there's a problem with the exemption certificate, you might just have to do a little more legwork to prove that the exemption still applies. Okay, last thing on kind of sales tax, and this also brings some other taxes into New York. New York has this wonderful system called its KISS system. And its KISS system is basically there simply to identify targets for audit. right? KISS, it sounds innocuous. But what does it stand for? It stands for the Case Identification and Selection System, okay? And what is this? I love this. I'm actually, after this presentation, I'm heading to JFK to JetBlue's terminal, and for the longest time, they recently took it down, but for the longest time, there was this massive 2-story sign right in JFK's terminal, just as you're kind of walking through security into the out of the terminal, and it says, IBM, helping New York State catch tax cheats. And what it was referring to was the fact that IBM built this super sophisticated software that basically did data analytics, and it found targets for audit so that New York State could go and audit them. Okay? Basically just looked for anomalies in numbers. That's what this software did. And first off, I love the fact that it's placed right at JFK in New York's airport. You know, it's like, welcome to New York, we're watching. I mean, that's basically what this sign said. And so what does it do? What type of transactions are we talking about here? First, it's going to analyze your corporate tax return sales versus your sales tax return sales, right? I know those two numbers are not supposed to be equal. There's reasons why they're going to be off. You know, one might be calendar or fiscal year, another one's, you know, New York says quarterly and not even, you know, fiscal calendar quarterly. So there's reasons those numbers aren't going to be the same. But generally speaking, over time, you would expect those numbers to be within a certain band. You know, sometimes one might be higher, next time a little lower. You know, there should be a reasonable band. To the extent those two numbers are not within that band, well, the computer, the software just says, here you go, red flag, something was weird here. You should go ask some more questions. How is it possible that your corporate sales are way up here and your sales tax sales are way down here? There may be some reasons for this, and reasons that don't result in any liability, but the point is, it's going to result in a question from the state. And here, it's not even, you know, I often get the question, well, what should we do about this? What should the accountants do about this? I'll tell you, the simplest thing is this. What happens is, look, you guys do the corporate returns, and you do everything you're supposed to. You do it well. You tie it out to bank deposits, and you know, do all your checks to make sure everything's accurate. But the company doesn't want to pay maybe for the more frequent sales tax returns, and they say, don't worry, we'll handle our sales tax returns. And they don't do all of those checks. There's a little more, you know, slippage with respect to how they do things. So what happens is the corporate return numbers are usually pretty solid, but the sales tax return numbers aren't. So what you guys can do, again, is just simply ask, look, you do the sales tax returns, but just send me a copy of it. Keep a copy in your file and check. Are these numbers, you know, when I add them up, looking solid, looking good? If not, again, you can have a conversation with your client and maybe drum up some more business.
In New York, don't forget, it's off the quarter.
You bet. It's not calendar
So
quarter.
reconciling is different than it is in Jersey.
And New York's accrual
Yep.
versus usually your income tax is cash.
Yep. So there are reasons it's going to be different. But again, if we're talking about, you know, $50,000 when the business is making, you know, $500,000, we're talking less than 10%, something less than that. I don't think the auditor is going to care about that. But if you're talking about a business that has, you know, a $2 million difference, well, that's potentially a problem. You know, when you have, you know, depending on how much the total sales they
The
make.
1099Ks on their computers now.
Yep, so, okay, let's talk about some other ways that they find you. What about credit card ratio? New York State knows, I mean, this software knows essentially what businesses typically file. You know, what businesses, if I'm a restaurant, I am in a certain geographic area, New York State gets information from credit card companies that have customers in New York. So any business that operates in New York that is processing credit cards, the credit card company has to make an informational return to the state. Well, if the state now gets the sales tax returns and they get information from the credit card companies, they now know what's the taxable, or what is the cash to credit card ratio. And if your ratio is way off compared to other businesses in that geographic area and that industry, you're an audit target. Again, it's looking for anomalies, numbers that don't make sense. They get information from insurance companies and liquor distributors and franchisors. You might sit there and think, well, who cares? I don't represent an insurance company or a liquor distributor. No, but you might represent the auto body shop down on the corner. And now, New York has the ability to say, okay, the auto body shop is filing sales tax returns that say their sales are here. But I'm getting information from the insurance company that say they paid this much in insurance proceeds to the business. Those two numbers aren't reasonably close. Again, automatic audit. Similarly, the liquor distributor, you might not represent any of them, but you might represent the restaurant or bar down the street. And there, if this bar is saying sales are down here, but it's buying liquor way up here, you're gonna be on their radar.
My clients always pour a 6-ounce shot.
Yeah, I gotta go to those bars a little more.
They go to Costco and buy the liquor so they don't go through Gallagher.
There you go, and they lose their liquor license by doing so.
Right. So the point is that New York State now has such an amount of information that it has access to, and there's so many ways for it to cross-reference. It's gotten to the point that where if a business is starting to play games, it's really not a question of if they're going to find you. It's a question of when. There's just so much information now that's out there. A few other quick things. If you have any clients, Mark briefly touched on this. We talked about art galleries. Mark briefly touched on this. But if you have New York City residents with Schedule C income, but they're not filing the UBT, well, what is Schedule C income but UBT? I mean,
Wait, isn't there exemption?
there is. There are certain amounts and that where it won't apply. But again, it's a red flag. It is. They raised that a few years back. But again, it's a red flag. It's just something to say, hey, we've got a resident here that's not with a Schedule C income that's not filing UBT. No box. I do want to mention this because this deals directly with you guys, with tax return preparers. On the New York State, a non-resident tax return, there's a question that says, do you or your spouse maintain living quarters? What's that?
3 questions.
Yeah, there are. You're right. And there's also, on a resident return, if you have living quarters in the city. So yes, there's a bunch of different ways they can look at this. But the main question is, do you or your spouse maintain living quarters in New York? You answer that no, and you end up having a place in New York. Not only is that going to create an automatic penalty for the customer, for your client, for the taxpayer, that also is going to get potentially you hit with return preparer penalties. And again, there's $1,000 per return if there's no reasonable belief for the position you took, and $5,000 per return for reckless disregard. Well, you might be sitting there thinking, well, hang on, reckless disregard. I'm a good tax return preparer. I don't recklessly disregard anything. I sit down with my clients. I've got the kind of file intake form. I ask them the questions. I asked them, do you have a place in New York? They said no. Do I have to know?
Does that mean own or rent?
Doesn't matter. They just say, do you have your maintain? Do you or your spouse maintain?
Maintain
You may
is a
not know.
dangerous word.
You may not know, because it's rental, if it's owned, then it's real estate taxes involved. But if you rent, the client may have never told you, you're a New Jersey person. Do you ask every New Jersey person, does he have a place in New York?
And that's a good
Every
good
person from
question.
Connecticut, or anybody,
In that situation where they're renting and there's no real estate taxes, you're probably not going to get hit with a penalty. I get you. I agree. Where preparers are getting into trouble is where you have that box checked no, but on Schedule A you're taking a deduction for the mortgage interest or for the real estate taxes paid. In those situations, that is reckless disregard for the facts. How can you on page 1 answer this question saying no, but on Schedule A take a deduction for the place that didn't exist? That's a place where return preparers are getting hit.
How much use does it have to have?
So we're going to start getting, so in order to make someone a resident, how much use does it have to have? The answer is there's no bright line for that, but very little. Question is, do you use it as a resident? Look at the Barker case. Let me give you an example. Barker case just went up. We litigated this case, but Mr. Barker was a Connecticut resident who commuted to New York City every day, right? Was in the city all the time for work, was in more than 183 days. The question was, did he maintain a permanent place of abode in the city or in the state? He didn't have an apartment in the city. What he had was a home in the Hamptons. That's right. 17. Actually, there's one year where I think it was only 12 days. 12 days is when he stayed there. You don't have to spend 183 days at your permanent place of abode. Those two tests are not connected. He had a permanent place of abode. It was there for him year-round use. It was suitable for year-round living. It wasn't some cabin in the woods. He only used it 12 days in 1 year, and that qualified. So I don't have a bright line test, but the point is, you don't have to use it much. You just have to have what they call a residential interest. That's the buzzword that the state gave us. And how do you have a residential interest? Well, you keep stuff there. You have a key to it. You can come in.
Tax?
What's that?
And that created the UBT tax?
Not UET, no, this was a residency issue. This was a residency issue. This was, yeah, was he a resident of the state? And what was problematic with Mr. Barker is he got taxed twice. You don't generally see this with Jersey, but Mr. Barker, he was a hedge fund guy, and the majority of his income came from carried interest. Well, carried interest is considered, it's like an intangible, it's like a capital gain. And so Connecticut took the position, look, he's a resident, he lives here, his family's here, he's domiciled here, his true permanent home is here, we can tax all of his income. New York said, well, wait a minute, he's a statutory resident of New York, he's a resident, we can tax his worldwide income. And they both taxed that carried interest. You might be thinking, well, why didn't Connecticut give him a resident credit, right? Well, Connecticut's resident credit is only on earned, it's only available for earned income. And income from intangible items like carried interest or capital gains is not earned income. So he got hit by tax in Connecticut and tax in New York. So it can lead to, and actually, you know what? This is a good way to hand it over back to Mark, because Mark's going to go over some residency issues, and he'll go through this in a little more detail.
Thanks, Joe. And Joe will be back with some concluding remarks about abandoned property of all things.
We saved the most exciting stuff for last.
Joe likes to
better
say,
than sales tax? Oh, I can't wait.
I love sales tax. You didn't like the peeps?
Joe likes to call what he does after this dessert. It's the dessert for the crowd.
That's right.
It's interesting because most crowds desert him. All right, so I wanted to talk for a couple of minutes about some New York State residency issues because we see this issue with New Jerseyans all the time. Obviously, you've got clients who live here, but they may maintain an apartment in the city. They may commute in for work. I'll get back to that one. Bottom line is New York has a lot to do with non-residents because 43% of U.S. taxpayers with income of over $10 million have some income from New York. And half of New York taxpayers with incomes of over $720 claim to be non-residents. And non-residents earn more than $90 billion in New York in 2014, the last year the records are available. So New York's got a lot of economic activity going on, and therefore residency becomes critical. Obviously, why do we care if somebody is a resident of New York? Because the tax rules are very simple. If you are a resident of New York, you pay tax on only one thing. That's the one, everything. Non-residents, of course, only pay tax on income earned here, and we'll talk about that. But if you're a resident, it's everything. And that's why we want to be careful about New York State and New York City. Now, when it comes to how do you move out, because as I mentioned at the outset, moving to Florida, moving to Texas, that's becoming more and more popular. Well, interestingly, the rules in New York are identical to the rules here in New Jersey. And that is that in order to establish your change of domicile, in order to get out of Dodge, you got to do two things. You got to leave the old state, and that's pretty straightforward, but you've got to land in the new state, and you got to stick the landing. That's a problem for a lot of our clients who don't realize that if you don't stick the landing, you got a problem. What do I mean? I leave New York, lock, stock, and barrel, and I travel around the country. I spend a month out west. I go here, I go there. I could travel for years. And finally, I wind up in Florida where I'll stay the rest of my life. Well, that's interesting, except those years, I could pay tax to New York. I may have left, but I haven't landed. Have I landed in a new location with the intention to be there indefinitely? We see this quite frequently when people say, I'm leaving New York, I'm leaving New Jersey. I want to go to the south of France. I've always loved it there. That's where I want to retire. Well, that's great. Are you going there forever, indefinitely? Absolutely. What's your visa status in the EU? Oh, it's a 5-year visa. Well, did you apply for permanent residence? Well, no. Once I get really old, I'm going to come back for health care. I don't want to give up anything. So let me get this straight. You moved to a place where it's illegal for you to stay indefinitely. That's where you went. That's a tough one. Changing your domicile to a foreign country gets really, really tough. And the landing also has to be for real. Here is a very typical situation that our very clever clients come up with all the time. I'm sitting here in August of 2018, and I'm about to sell my company. I am going to make a boatload of money. And I don't want to pay New York, between the state and the city, 12%, which is no longer deductible. 12% on my $100 million gain? No way. No way am I going to pay $12 million of tax. So I'm moving to Florida. And if I'm smart, because there's this thing called the accrual rule you want to be careful of, but if I'm smart, I go down to Florida. It's 2019. I enroll the kids in school down in Florida. I've left New York. I sell my house. The wife's with me down there. We put the kids in school. In 2019, I'm going to wait a year. 2019, I sell my stock. I have a huge gain. I pay no state tax. And then after another year, I say, you know what? August in Florida? Not for me. Hurricanes, heat, humidity, bugs, lizards. There's lots of things about Florida you can find a dislike. So a couple years later, I come back to New York and resume my life. Well, one of the greatest things about New York residency auditors is they have phenomenal 20/20 hindsight. They know your intentions by what they see you've done. So here's the problem. In 2019, you went down to Florida, or 2018 you went down, and you had this huge liquidity event. In 2019, you get the money. Your 2019 return is filed by maybe as late as October of 2020, right, the next year. And New York has until 2023, 3 years, to do its audit. If you're already back by the time the audit begins in 2021 or 2022, good luck proving that you went to Florida forever. How do we know? Because you're already back. And that's not a landing. So that gets very difficult when people think I'm just going to move for the liquidity event. The other thing you need to remember, yeah.
In that case, in 2019, you wouldn't file a New York return, so would there be a statute of limitations?
If you don't file a New York return, there is no statute of limitations.
In that case,
you are...
probably would never file. If
I
claim I'm a Florida resident for all of 19.
Yeah, most of the time we tell our clients, if you're going to change your domicile, well, first of all, they would have filed in 2018 a part-year return.
Right.
And by the way, one of the most common errors people make is taking the position that your client became a Texan or a Floridian effective January 1st. We see it all the time because it's easy. I wrote an article that's called Nobody Moves on January 1st. Because here's what happens. There's a disconnect between our clients and auditors. Auditors, for the most part, are some very nice people. And they're very nice people. They make about 50, 60 grand a year. And why is that relevant? Because our clients make 50, 60 million sometimes. Our clients are not in the same strata as auditors. So when our clients decide to move to Florida, many times they buy a big, beautiful place. And an auditor will say, well, that's great. Show me the moving van. Moving van? My client has so much money, he can afford a TV and a desk both in New York and in Florida. Well, already there's a disconnect. The auditor expects to see a moving van. You haven't moved anything. You said you moved to Florida. What moved? Well, he went down there. We could talk about the other issues. But the issue here is, how do you tell an auditor that you moved on January 1st when the auditor asks the question, where were you on New Year's Eve? Oh, in my new beautiful home in Boca. And where were you New Year's Day? Well, I drank heavily, but I still woke up in my new beautiful home in Boca. So let me get this straight, says the auditor. Sometime between when you put your head on the pillow at night and you woke up in the morning, you moved to Florida? Well, I didn't exactly move that day. Understood. But just so we're clear, so you've just admitted the most important thing on this year's tax return is wrong. All right, let's start the audit. It's terrible. Question here?
Aren't you a resident the year before then? If you moved, you spent in Boca, you could say, so I moved December 1st.
Well, the answer, sir, is you moved the day you moved. The day you were in New York or New Jersey on a Monday, you got on JetBlue, and you got off the plane the next day, that's the day you move. The day you can say, I was in Florida this day, and the next day, I was in New York this day, the next day I was in Florida. That's a day you move. Nobody goes to sleep at night and moves. You have to physically move. Yeah.
I've had this issue on some audits, I call it a creeping move, where the client bought the Florida residence 10 years ago.
Yeah.
And as part of a plan, not with a $100 million capital gain on the horizon to do an end around, but they're getting into their 60s and 70s, but they want to keep the residents here, so they do the 5-month, 7-month deal, the snowbirds.
Yep.
And then you have the audit, and they ask, like you're saying, and the client moved 10 years ago. The client never needed they keep closing both places, they never hired United Van Lines, and it's, you get difficulties with that.
It's tough finding records 10 years earlier, too. Pictures can often be very helpful, showing pictures of your stuff in Florida. But that's the key. You've got to identify a date of the move. The other thing is, and as this gentleman points out, spending more time in Florida. We'll talk about how that's important. But it's not just a quantitative analysis. We don't just count days. We count the quality of the days. What kind of days do you spend in Florida? What if I have this situation? My wife and kids stay here in New Jersey. I go to Florida all week long. I don't come back until late Friday night. That sure looks like I'm a commuter, doesn't it? Even though I'm spending 5 days in Florida and only 2 in New Jersey, where do people go at the end of their work week? Home. The bar. The bottom of our river if they're in New Jersey. Yeah, you go home. And that's what auditors expect. We look at where people sleep at night. I mean, I'll give you a great example. I've got a New Jersey couple that decides to buy a pied-à-terre in Manhattan. So do I have a New Jersey couple who is simply commuting and spending a night here and there in New York? Or do I have a New York couple who weekends in New Jersey? Tell me where they do spend the weekends. Tell me where their kids are enrolled in school. I'll tell you where they live. So changing your domicile, changing your home, is more than just filling out pieces of paper. There were old rules about you go down to Florida, you fill out an affidavit of domicile, registration to vote, homestead exemption, driver's license, yada, yada, yada. Those are all interesting and fairly meaningless. No one has ever won or lost a case because they did or didn't fill out a piece of paper. By the way, I always recommend doing that stuff. It's never a bad thing to do it. It's consistent with your intent. And sure enough, we do have auditors once in a while who say, well, wait a second, you moved to Florida, but you still voted in New York. So you're okay with committing voter fraud. So it's always good to do it, but don't put too much faith that those pieces of paper make you a Floridian. New York and New Jersey look at how you live your life. And that's really what counts when you change your residence. I'll mention that in a second. When we look at whether you've really changed your residence, your domicile, your home, the first question we look at is, where is your bigger, better, nicer place? We assume the bigger, better, nicer place is home. You want a great case? You downsize the place in New Jersey. You start renting in New Jersey. You buy a big, beautiful home in Boca. That's an awesome case. You want to lose quickly? You keep your 5-bedroom place in Basking Ridge, and you rent a condo in Delray. That's terrible. Big and beautiful up here, rental down there. What's more representative of temporary than renting? That's a very bad case. So the home factor is important. And be careful your clients recognize all of the rules that apply when they move. So for example, I moved to Delray Beach and I claim it to New Jersey that I've been a Floridian now for the last 4 or 5 years, and I decide finally I'm going to sell that big, beautiful home in Ramsey, New Jersey. Well, as we know, husbands and wives get a $500,000. You were from Ramsey?
It could be me.
I was there over the weekend.
There you go.
Nice little downtown area. I like that. $500,000 exemption for husbands and wives, right?
You pay
Wrong.
real estate tax.
2 out of 5 years.
It's got to be your principal residence 2 out of 5 years. I've been in Delray for 4 years. I've lost it. When I realize that and I say, oh my gosh, that's $500,000, let's go for it. I've just admitted I've been lying for the last 4 years.
Not Kings Point, though.
Are you in the White House?
Am I in the White House? No, but I apparently am qualified. Sorry. But I digress. Business involvement. We look at where you're actively involved in a trade or business. That's why it's critical to look to see whether you are commuting or whether you are here in New Jersey because you're running the place. People always tell auditors, oh yeah, I've got nothing to do with that business upstate or in New York or in New Jersey. Auditors aren't stupid. Auditors very frequently will drive to the local business and look in the parking lot and see the one space reserved for Mr. Jones. The guy who doesn't work there? Why does he have his own space? Well, he's a bit of an egomaniac. Speaking of White House, he's a bit of an egomaniac. Here's what auditors do. You say, Mr. Jones really doesn't work. He hasn't worked in years. He has no business involvement up north. Yeah, he keeps a space there, so if he drives by on a weekend, he can feel big and strong about it. But, he doesn't really do anything. Fine, the auditor then calls the switchboard. Hey, can I have Mr. Jones's assistant, please? Hold on. Hold on? Why in the world would Mr. Jones have an assistant when he doesn't work there anymore? Auditors aren't stupid. They're getting good at this. They also use this thing called the net. I've had auditors who, before the audit has even begun, have gone on Facebook. I had one client who left New York because he hated it. He was sick of the cold and crime. He had definitely left New York, except when the auditor went on his Facebook page, I heart New York. Doesn't mean he loses the case, but it raises some questions. I've got a case right now, though, where my client left New York, his wife and kids went to Florida, he went to China to work, and when he sent back all his stuff, he made a Facebook post. I've just sent all my stuff back home to Rochester, New York. Oh, that's a killer. That's an absolute killer. And, you know, it's hard for the auditors to not laugh at us, and they show us this thing. Because, again, residency comes down to intent. Where's your client's intent? We talked earlier about the 183-day rule, and, again, we can circle back to that. But this, when it comes to domicile, where your home is, the 183-day rule is fairly meaningless. If you have an issue where you're up north almost 183 days, you're never going to prove your case. Because you or the client have the burden to prove that you've moved to Florida, Texas, wherever, by clear and convincing evidence. And if you're in New York 180 days and you're in Florida 180 days, that ain't clear and convincing. You know, this is clear and convincing. Yes, sir?
Whenever you have more than one home, you spend 6-7 months in Florida, but then you have a house in South Carolina, you have a house in Maine, you have a, you move around.
Yeah.
You go visit your kids, you go to Europe, go
Why don't the
to-
kids visit you for a change? You know what? My son, well, never mind, sorry.
Okay, but the point is, you may not spend 6 months anywhere.
The 6 months is meaningless. Here's what we look at. You say you are a Texan. How many nights? I don't care about days, how you count days, 5 minutes is a day. No. When it comes to domicile, where do people go at the end of the day? No, I've got a New York City office full of people, none of whom live in New York City. How do I know? Because at the end of the day, they go home. So the question is, where do you sleep at night? And what I do, sir, is I compare how many nights are you home in Texas and how many nights are you in your old place in New Jersey. That's the only two I care about. South Carolina, meaningless. Europe, meaningless.
So if you spend 1 month in New Jersey and 4 months other places, and 6 months or 7 months in Texas.
You got a great case. But here's what we see all too often. People are familiar with the 183-day rule, so they're only up north in New Jersey 170 days, 160 days. And they do spend a month in South Carolina, and they do spend 2 months in California, and they go here, and they go there. And suddenly I add up their days, and they may be in New Jersey 170 days, but they're only home in Florida 100 days. The legal term for that, sir, is sucks. That is a terrible, what's that?
Really?
Why would Florida or Texas be your home when you spend twice as much time in New Jersey?
You could live in New Jersey and be on vacation 8 months a year. Travel.
Right, you made my point. You live in New Jersey. I'm trying to prove that the client lived in Texas.
I'm saying you live in, I just think you live in Florida and you like to travel.
Well, the problem is
Why travel to New Jersey?
the taxpayer has to prove their case. And if they're sleeping more frequently in their old home in New Jersey than they are in their new home, why is their new home the center of their life? They're spending more time in New Jersey on that bed. You have to spend more nights in your new home, and not by 50-50. We tell people 2 to 1 if you want to be safe. Now, clients will be upset. They think that's ridiculous. They heard about the 183-day rule. I had somebody call me just yesterday and say, hey, Mark, I just went down to Florida for the season. I'm doing my time.
You may be doing time.
You may be doing time.
In your example of 170 days, my client has a big sailboat. It's moored in Florida. He's got a condo in Florida. And he probably is out on the sailboat a total of about 3 months out of the year. He spends 170 days up north in the summer.
Where's the sailboat? Is the sailboat in the Florida waters, or is he coming up to the north?
Well, it's moored in Florida, but he travels to the Caribbean, he travels to Maine, he travels all over.
Yeah, I think, look, if I'm an auditor, your client is saying, I no longer live up north, I live in my new home in Florida. Why don't you spend much time there then? That's what I would ask if I was an auditor. If I were an auditor, I would expect your client to spend more time at home, where he claims his new home is, than in his old home. And so I take out all the sailing days. I take out all the travel days. I just compare the place that used to be home with the place he claims or she claims is home. And the place they claim is home, they gotta sleep there more, or it's a very short audit. What else counts? Near and dear, they ask kids whose parents are being audited, where do you keep your teddy bear? You keep your teddy bear at home. We all know that. They ask clients. Joe's got his in his briefcase there.
You pay sales tax on it?
He paid sales tax on his Build-A-Bear, which I thought was so cute. He put a little heart and said, I'm a tax lawyer. He was very proud. We kind of humor him. It's cute. It's cute. He's fairly naive.
Going to the Build-A-Bear in Kennedy Airport.
I don't want to say he's naive. He's a Buffalo Bills fan.
You mean the only indigenous New York team? The only indigenous New York team? You guys got 3 teams, or what? Yeah, 2 teams here.
Yeah, Buffalo Bills fan. Anyway, we look at where clients keep their best stuff. This is why auditors ask, where is the moving van? Because they want to find out if you move stuff. And we expect your insurance, your safe deposit box, everything should be down in Florida. If you're on vacation in New Jersey, why would you keep a safe deposit box, your most valuable possessions, with you on vacation? Who does that? Here's another thing. People are very concerned about doctors. Oh, can I keep my doctors? The truth is you really can. If you've got some special issue, I would suggest, notwithstanding any of you who might be Floridians, that the medical care in New York City is, bar none, the best medical care you're going to get in the world. If you've got something funky going on, I know I would go to a New York City practitioner. I would go out of my way. I would go on vacation. I would go to a New York City hospital. But who in their right mind travels on vacation or otherwise to get their teeth cleaned? Nobody does that. When do you get your teeth cleaned? When you're home. That's the kind of stuff that auditors are looking as a connection to home.
And the favorite beauty parlor, too.
And my favorite, how do you know about my beauty parlor? That's none of your business. How I choose to identify.
I handle that all
Somebody
the
said to me the other day, how do you identify? I said, you know how I identify? Tired. That's how I identify. And finally, the family factor. Like I said, we look at where kids go. We look at where the children go to school. That's practically determinative. We also assume that married couples live together, have the same domicile. It is unusual for a happily married couple to have separate domiciles. Yes, sir?
Have you actually ever seen a New Jersey residency audit performed by the Division of Taxation? Because we as a group almost never, and we talked about this, New Jersey has an army of people who attack the resident credit. That's their main, that's their main.
New York's learning from that. New York's got a bunch of people. Here's an interesting case. I've got a case where New York is looking at it. I've got a guy who lives in New York City, works in New Jersey, and pays New Jersey a whole bunch of tax on 100% of his income. And then New York files a return and takes a credit for what he pays to New Jersey. New York says, doesn't he ever travel? We want to see your client's travel and expense reports to see if because he took a credit for 100% of the tax he paid in New Jersey, but he paid too much. And New York State said, we're not going to give him a credit just because he chose to pay New Jersey too much. He was only in New Jersey 70% of the time. He paid tax on 100%. That was nice of him, but New York will only give you a credit of 70%. The answer to your first question is I've seen one New Jersey residency audit, but I understand that with Mr. Murphy in office now, things are a-changing. And then New Jersey, as you know, is also in a budget deficit. The governor just vetoed a couple of budget bills yesterday with some tweaks in them. We think the division is going to get very interested in non-residents very soon. Actually, you probably saw a few years ago, maybe 2 years ago, there was a hedge fund guy who was in the paper where the governor, Christie, actually called him and said, please don't leave, we need your money.
It's the guy who just bought the Carolina Panthers.
Exactly right.
$2 billion.
Exactly right.
Cash all cash.
Sure, no, because there were no New Jersey taxes.
Tepper.
David Tepper.
They said his move was to save $330 million a year.
Yep, and Governor Christie personally called him. Anyway, so that's what I've got on residency. I know we're down to 8 minutes, 7 minutes, and Joe says he can do abandoned property in 7 minutes. So name that tax.
There is one little thing on residency really quick. Now, I'm a litigator. I like to fight with the state. And I generally agree with Mark when he says that if you want a good case, get that disparity between Florida and New York as big as you can, because then you don't need us, right? But I just want to put on your radars, it's in your materials, that if you do have a bad case, if you do have one of those cases, don't just write it off. Because there's a case called Matter of Patrick. This is a case where the taxpayer spent 183 days in New York, the most you can possibly spend in the state without being considered a resident. And he claimed to have changed his domicile to Paris. Again, the foreign place, the place that it's toughest to change your residence to. And he only spent 80 days there. 183 in New York, 80 days in Paris, kept the big New York place, was employed in the city, his business factor was in the city. He wins this case. How does he do that? Well, first he pays attorneys a boatload of money, which is why you don't want to have your clients have to go all the way through this. So I agree with Mark. You get that time disparity as much as you can. But if you can't, if the bell has already been rung, this guy had a great story. It was like, this passionate love affair that, they started it in high school, and then they each married somebody else, and then after 40 years returned to one another, met back up in Paris, and that was why that was the center of his life. And it's this great case. There's another case, Matter of Blatt. I love this case. I litigated this case. And Mark and I were there. Greg Blatt was a great witness. He was very, very compelling. And this is a case where he said he moved to Texas, but he did such a good job for the company in Texas, they promoted him to the parent company back here in New York within a year and a half. So he said he claimed to move his domicile, but it's like in Mark's case. The audit didn't occur until 3 years later when he was already back in New York. So you kidding me? You think he actually moved to Texas? Well, we won this case despite these terrible facts. The time was about equal. He kept the big New York place. He only rented in Texas. All of those terrible facts. And it was because he could tell this amazing story where, look, when he went to Texas, he was expecting it to be permanent. He started to grow his roots, but he didn't know the city, so he didn't buy immediately. And he did such a good job that this unexpected promotion brought him back. But he, when he moved, was intending to be there permanently. And that subsequent fact that he came back didn't vitiate the fact that he had the intent to remain in Texas, 2 years prior, a year and a half prior. So just keep in mind that when you do have these terrible cases, think about the story that you're telling. Think about how that story relates to where these people, the center of these people's lives are. By the way, in this case, the dog case is what people call it. The judge decided that he moved to Texas when he was actually flying back to New York, and he was writing an email. I remember going through the boxes of evidence on this, and it was 1 a.m, and I find this email, paper copy of this email, and I read it. I'm like, oh, we just won the case. Because in this email, he's typing to a friend of his, again, contemporaneously, while the audit's going on. This isn't after the fact, after he talked to all his tax advisors and knows what's important. So contemporaneously, he's just typing an email to a friend that says, I'm on my way back to New York right now. When I return to Texas, I'm bringing my dog with me. So I guess it's official. Big D is now my home. Big D being Dallas. What better evidence? Forget all of the time. Forget the fact that he rented in Texas and owned in New York. Talk about, again, domicile is all about intent. Talk about great evidence of intent. He's just writing an email to a friend, shooting the shit, and he says, I live in Dallas, Texas. I knew at that moment we had won that case. So just remember, if you have a tough case, just
Bring the dog.
the dog
Bring
carries
a dog,
special
buy a
weight.
dog, yes.
That's right.
He was wearing
Okay.
his Giants jersey at the time? Cowboy jersey, didn't
No.
couldn't bring himself.
Right. So, all right, so now on to the greatest topic you're ever going to hear about. I mean, what screams excitement like abandoned property, right?
Sheep.
In New Jersey, he always screams.
So the reason I'm putting this on your radar is because New York just hired 3 of the larger private accounting firms. This means that these audits aren't necessarily conducted by state employees. They're conducted by private audit firms who may have a financial incentive in the outcome of the audit. Now, what is abandoned property? First off, this is nothing new. This has been around forever, since roughly the 1940s, 1950s. Roughly the same amount of time Mark Klein's been around.
Oh.
You've been giving it to me. I got a teddy bear that says I have. Anyway, so they've been around forever. And like Mark said, the states are hurting for cash right now, right? New Jersey's hurting, New York is hurting. don't want to raise taxes, don't want to impose new taxes, can't cut spending. What can you do? You've got these laws that are on the books where all you have to do is start enforcing them. There's a ready stream of cash out there because nobody complies with this law. You know, if you were to come up to me 5 years ago and say, Joe, what's up with the New York's abandoned property law? I'd say, abandoned what now? Now, how many people here have dealt with abandoned property issues for clients? Anybody? Oh, okay, wow, that's more than I would have thought. Okay, so yes, it comes up, and it's starting to come up more in New York. Why does this matter? Again, every state has an abandoned property law. It applies, New York's law applies to everybody. I don't care if you're a C Corp, S Corp, LLC, sole proprietorship, individual, charities, governmental agencies, all have to abide by this, comply with this law. What is abandoned property? Well, in order for something to be abandoned property, you've got to satisfy three things. I mean, generally what we're talking about is that it's an intangible item of property. Usually when I talk about this, people get this mental image of a dilapidated, boarded up house. And that's not what we're talking about. We're generally talking about checks, debts. Deposits, check, exactly right. Intangible, something you owe somebody else, a debt. And that debt has to be fixed and certain. The amount has to be certain, and the liability has to be fixed, meaning it can't be a contingent liability. Something where you'll owe me this if I do this, and that thing isn't done yet, right? That's not fixed. So it's just something where clearly you are legally entitled to the money, and the amount is set. Okay, that's abandoned property. And then lastly, it's got to be abandoned, right? That's the word abandoned, it's right in it. The owner of the property has to have not communicated with the holder, the person or the entity in possession, for a set period of time, usually 3 to 5 years. There's been an abandonment because there's no communication between the holder and the owner of the property. If you have those three things, and again, sometimes this applies to tangible property, but usually not, you have a situation where that money or that debt, that liability, has to be paid instead of to the owner, to the state. And the idea is the state holds the money while this owner remains kind of out of possession of the property. And the reason the state gets to hold it is because the state's got to pave roads and provide hospitals and police. And, rather than letting the benefit of the money accrue to a private entity, we're going to give the benefit to the state, which has, obligations to its citizens. That's the idea. As you mentioned, those are the top categories of abandoned property. The first four are really the big ones, where about 90% of, if we're dealing with just a general business corporation, where the liability lies. Uncashed payroll checks, uncashed payable or vendor checks, unused gift certificates. Even if there's an expiration date. In New York State, even if you have an unused gift card that says expires after 2 years or expires on a certain date, even then, that has to be remitted to New York State.
Even if you buy, like at a restaurant, you buy a $50 gift certificate to a restaurant, they don't know who the person is. There's no name on it.
Yep.
They don't track it that you came in or didn't come in.
I'll do you one better. I go to Target and I put $50 on a gift card, Target card, right?
Okay.
And I pay with cash. So there's no way to track me, who it is, who's the purchaser, whatever. Plus, it's a gift card. It's designed to be given as a gift. So there's no way to know, for Target to know who the owner is, right? Doesn't matter. None of that matters in New York. In some states, that stuff matters. It doesn't matter in New York. Cost. The Council on State Taxation did an analysis, a 50-state analysis of all the abandoned property laws. Guess who scored dead last in terms of most aggressive?
New York.
New York and Delaware. Two most aggressive states. For reasons like this. That gift card, even if it's got an expiration date, even if you don't know who it is, New York likes those accounts best because they know no one's ever going to come to collect on it. New York, in perpetuity, is always going to have the benefit of that money. That's the best kind of abandoned property from the state's perspective.
But the house isn't keeping track. Target may do it because it's large, but the actual restaurant, the local restaurant down the street, which gives away, sells maybe 5 a week.
So what happens in a sales tax audit when the business doesn't have records?
They estimate
They estimate it. They estimate it. And that's
the
what's
guy
going to
may
happen.
not track whether people came in or didn't come in.
But that's what's going to happen in an abandoned property audit. They're going to say, fine, you're right, you don't have records, just like in a sales tax audit. Here's what we're going to do. I'm going to test for the past 2 years for which you do have good records. And any liability I find in that 2 years, I'm going to project back, assuming that's representative of what the business does, just like in a sales tax audit. Here's the problem. In abandoned property, there's no statute of limitations. Even if you file a return I mean, in this case, usually nobody's filing a return, so there's no statute of limitations. But in New York, even if you file a return, there's no statute of limitations. On top of that, there is, like even if you try to file for a voluntary disclosure in New York offers a voluntary disclosure program. Guess how far it looks back? 10 years. 10 years, that's pretty far. I mean, under the tax voluntary disclosure, which again I have in my briefcase right here, it's generally 3 years.
Bear?
Yeah, with it right next to the teddy bear. Generally 3 years. If you do something really nasty, like collect and not remit, you know, something that's fraud or potentially criminal, it's 6 years. So it's a really long statute of limitations.
You gotta wrap up, so
Yeah.
they got their next speaker.
Yeah, we're just about set. So just really quickly, returns filed March 10th. You have to contact these owners before you remit the money to the state. It's called due diligence. You send them letters. Again, file a return March 10th, just like a tax return. It's an annual return for everything that became abandoned in the previous year. Mean penalties. There's 10% interest and $100 a day for every day a return is not filed. That equals $36,000 a year for each year that a return is not filed, and it keeps going.
Even if there are no things to be remitted?
No, if there are no things to be remitted, then there's no requirement to file a return. Only if you have a liability.
So reverse out all the old outstanding checks.
That's right. That's, well, even that though, you can't really, that doesn't work because businesses try to do that. There's still a liability. You know, there's technically still a liability. Okay, thanks very much, everybody.
You guys will leave it? Yeah. You guys work at all with Corey Rosenthal?
Oh, sure, I work with
I'm
Corey.
a partner.
Oh, okay.
Co-resident out here in.
Oh, sure, and Peter Rabinowitz.
Yeah, and John Moorhart, you brought everyone you can get from the state and city ranks.
Tell them I said hello, please.
Yes. Let's see. Have a safe trip.
Thank you.
Thank you much. Out to the 100 degrees.
Thanks very much.
See you later.
Hey, Mark, Steve Bromberg sends you his best.
Tell us that.
Who can tell me how to make this full screen?
Go abracadabra.
What?
Back to shul.
Nobody? Nobody can tell me which one of these icons makes this full screen? As you can tell, I am not a computer wizard.
Try the plus.
What? Plus?
Try the plus.
That's just too enlarge. See, that's not good. You can't.
It's something up.
I want to get rid of it. What?
Something
What about the one that had the two, to go to the left 2 times?
This
Try
thing?
that.
Is there an X there?
There you
There
go.
we go.
Perfect. You get the bonus prize.
Get
All right.
the T-shirt.
So today's theme: back to school. Got any kids or grandkids that have this attitude as far as school?
Is that Barney Rubble?
No.
I got one of them.
I got one going back to Friday.
Try to let them know one of the.
They didn't talk about this with their New York update and Governor Cuomo wanting to raise revenue. Report: marijuana could generate millions in New York tax revenue. I don't know where they come up with these figures, but they're estimating that the state could rake in up to $678 million in annual tax revenue from a 15% tax rate. On the next page, the health department said that if New York doesn't legalize recreational marijuana, it is at risk of missing out on revenue because customers can go to nearby states that have legalized cannabis, including Massachusetts, Vermont, and Maine, as well as Canada. Legalization in neighboring jurisdictions raises the likelihood of revenue flowing from New York into those jurisdictions. Marijuana legislation has become a hot topic in the governor's race. Governor Andrew Cuomo has not endorsed legislation, but his Democratic opponent, Cynthia Nixon, the former Sex and the City actress, is backing it. So we'll see where that goes.
Tonight you're going to debate.
Debate,
For an hour.
Tonight's a debate?
yes.
In New York? Well,
1 hour debate.
all right, well.
Oh, weird.
Everyone knows that under the New Jersey budget agreement, that we have a new top gross income tax rate of 10.75% on income over $5 million. So the division came out with guidance, and you have a now once wages reach $5 million. I mean, we all have I have a couple clients in that stratosphere. Certainly not myself personally.
That's not what we heard.
The withholding rate is 15.6%. So
So the tax rate is 10.75, but the withholding rate is 15.6 once you reach $5 million. So be aware of that. And like they said, of course, not deductible. Anyone hear about the net capital loss carry forward proposed in New Jersey? A bill filed in New Jersey would permit taxpayers to carry forward net capital losses. It was introduced by Deputy Republican leader Ronald Dancer. Under the measure, the state would follow federal limitations and restrictions on deductibility under Code Sections 1211, 1212. The bill would take effect immediately and apply to taxes beginning on or after January 1. Sheila Reinertson of New Jersey Policy Perspective told Tax Notes that she hasn't seen a fiscal note for the bill, but assumes the state would lose quite a bit of revenue under the measure. I think this would benefit primarily high-income taxpayers, she said. It's an avenue that New Jersey doesn't need to pursue at this time, considering the tax code at the state and federal level is slanted in the favor of higher-income taxpayers already. So, stay tuned on that one. New Jersey, to raise revenue, is going after United Airlines. Senate President Sweeney is planning to introduce legislation that would end the fuel tax break enjoyed by United Airlines to help pay for a $1.7 billion train service extension from Lower Manhattan to Newark Airport. Gets into how aviation fuel is taxed, and it would apply to qualifying airlines with more than 8 million enplaned passengers per year, which of course is United Airlines.
Right, and the prices in Newark are almost twice Boston.
So that's that.
JFK, too.
529 plans he touched on as far as New York decoupling. New Jersey, this final paragraph. Because New Jersey law incorporates IRC Section 529, New Jersey follows the federal expansion and considers the withdrawal from a 529 savings plan used for tuition at private religious elementary and secondary schools a qualified higher education expense for GIT purposes. So New Jersey is following the federal. New Virginia law requires reporting of taxpayer data breaches. This affects tax professionals, so we'll see if this happens in New Jersey or New York anytime soon. Tax professionals are required to report any breach of Virginia taxpayer data from income tax returns within a, quote, reasonable amount of time under a recently enacted law. It took effect July 1. Under the measure, income tax return preparers are required to notify the tax department, quote, without unreasonable delay after the discovery or notification of unauthorized access and acquisition of unencrypted and unredacted return information that the preparer believes has caused or may lead to identity theft or other fraud. The Virginia Department of Taxation identified more than 70 fraudulent returns within the first 6 months of the 2017 year, resulting from 7 tax return preparer data breaches, and it suspects there were many more it wasn't aware of in the absence of a reporting requirement. The preparer who signs the return must provide the department with his preparer, his PTIN, contact info, affected company name, tax ID, date of the breach, number of people affected, the type of information compromised, and information pertinent to addressing the specific situation. So if your computer network gets hacked and you're in Virginia, you've got to spill the beans and share with Virginia or face repercussions. They talked about the potential entity-level tax on New York State UBT, similar to what Connecticut did. I covered the Connecticut, I think, at the last meeting. So New Jersey is also considering this. The NJCPA State Tax Task Force is working with, again, Senate President Sweeney to draft legislation that will be titled the Pass-Through Business Alternative Income Tax Act. It will establish an entity-level tax on pass-through businesses to allow pass-through owners to get around the SALT deduction cap under the new federal tax law. Legislation has an interesting history. In January, NJCPA member Alan Sobel wrote a personal letter to Governor Murphy outlining the concept. When the letter was forwarded to legislative leaders, the concept took off. And then it lists on here who the members of the State Tax Task Force are. You will recognize some of the names, including some past chairs of this group. Jim Evans, Jody Kluskins, most recently, Mark Phillips.
John Coiro.
He's a past chair of this committee? Coiro?
Oh, yeah, past president of the society.
Oh, okay.
Not of this.
Okay.
And he's also the mayor of Totowa.
I'm aware of that. I mean, I've met the guy. Alan Price, of course, someone, Darren, listed alphabetically. And Jeff Kazaman, I trust most of you know, is the Government Relations Director for the Society. Then we have a second group, working to clean up the new combined reporting law. The NJCPA, as well as other business groups, were surprised to see that this got legislated, because supposedly it was not on a fast track, which was signed into law the same day by Governor Murphy when the budget was approved. Legislative leaders had indicated they would wait until after enactment of the state budget before moving on combined reporting. At the last meeting, I shared with the group in my handout that they put out an RFP seeking someone, third party, to actually write the regulations for them, because they don't know which end is up with all the different issues for combined reporting. And again, we have a cast of characters, some repeats, some other people who aren't on the other group, and there they are. Dubious distinction. New Jersey has the highest cost for doing business. Hey, that's earth-shattering.
Number 50.
Among these factors, New Jersey is ranked 50th, rock bottom when it comes to the cost of doing business, 44th for business friendliness. That follows a Tax Foundation report last fall that rated New Jersey dead last for its business tax climate. You can be sure the word is out that New Jersey is unwelcoming and expensive for companies large and small, which is a dubious distinction.
We're number one.
Pending legislation, if passed, could further weigh upon the backs of small businesses. A bill to raise the minimum wage to $15 an hour could be the death knell for small restaurants or other companies with slim profit margins that hire entry-level and teen workers. It would result in cuts in jobs and hours and mean fewer options for those entering the job market. Again, this is a op-ed piece, so it's not. It's just one the author's slant on this. It is not a business-friendly environment in New Jersey. No. Not friendly to big corporations who saw their state taxes increase this year. Not friendly to small businesses that are a big part of the state's employment and economy. There are more than 860,000 small businesses employing 1.8 million people. You do the math, that's 2 people per business. Gets you to 1.8 million people. So this was written by Lori Elbach, State Director for NFIB, which advocates on behalf of thousands of small and independently owned businesses. New Jersey report offers options to mitigate tax cuts and job act impact and institute fiscal reform. You may have seen this in the newspaper somewhere. A New Jersey legislative panel has issued a report, like the title says. The August 9th report by the Economic and Fiscal Policy Work Group, a 25-member panel created by the state legislature to identify needed fiscal and government reforms, makes several recommendations for lessening the impact of the new $10,000 state and local tax deduction cap and the $750,000 limit on mortgage deduction. The panel recommends lawmakers pass legislation enabling subchapter S corps, LLCs, and partnerships to pay state taxes equivalent to the GIT obligations of the owners and partners, which those individuals could then fully deduct, as was talked about. The report notes that the practice was in place from 1976 to 93, and reinstating it could provide a $450 million federal tax cut for the majority of New Jersey small business owners at no cost to the state. The panel also recommends allowing a GIT deduction for contributions to New Jersey-based charitable organizations and targeting additional tax incentives towards small businesses to support entrepreneurs in the state. Last paragraph. New Jersey became the second state to enact a workaround to the new federal cap on the state and local tax deduction when Governor Murphy on May 4th signed legislation authorizing municipalities, counties, or school districts to establish charitable funds for specific public purposes. Taxpayers who donate to a fund can receive a credit up to 90% towards their property tax bills, and the contributions can be claimed as charitable deductions. How many municipalities have enacted a system instituting one of these funds that you can? The answer is 0. Now, as they talked about, and I printed it out and brought with me, last week the IRS came out with an announcement, proposed regulations, under the general premise, as he talked about with his rubber chicken dinner before, that the definition of a donation is an act of disinterested giving, okay? None of us pay our real estate taxes because we like to. We do so because the law requires it, and if we don't, we could have our homes taken away from us, okay? And we do get things in return. We get, like you talked about, fire protection, police protection, schools, road maintenance, snow plowing, etc., etc. So if you pay your $10,000 in real estate taxes to one of these funds and get a 90% credit, you've got $9,000 back. So you've only made a $1,000 donation, which is, then the IRS said in this guidance, they're going to allow this situation where the tax credits are no more than 15% of the payment amount. So they give an example. Taxpayer makes a $1,000 contribution to an eligible entity. It's not required to reduce the $1,000 deduction on their federal tax return if the state or local credit received is no more than $150. On the other hand, they give an example. State grants a 70% tax credit, and the taxpayer pays $1,000 to the eligible entity. Taxpayer receives a $700 state tax credit. The taxpayer must reduce the $1,000 by the $700 state tax credit, leaving an allowable contribution of $300, which of course defeats the whole purpose. So I don't know if any of the state attorney generals are going to litigate this, but we shall see. In case you thought that the physical nexus was no longer an issue and everything is now today economic nexus and with the Mayfair case, not so. Oregon Supreme Court ruled August 9th that physical presence is not necessary for a taxpayer to be subject to the state's corporate income tax, upholding a $5.6 million assessment against Capital One Auto Finance. You can read the entire case at your leisure. Materials, all this material, as always, is posted on the Society's state tax webpage. They just, Joe, the younger guy from Buffalo, was just talking about abandoned property, unclaimed property. So the Treasury put out, I know the print is somewhat small on this, I tried to make it larger. They put out a press release in Trenton that there was a record $142.6 million returned to 50,837 rightful owners and heirs in fiscal year 18. Since the program's inception, the Unclaimed Property Act has returned approximately $1.73 billion to rightful owners. You know, when you open up the Star Ledger on the weekend, and or the Bergen Record, you know, a major newspaper, and you see that full-page ad that has all the names listed.
17 pages.
Yeah, because Aunt Tilly, who died 12 years ago, left you a bank account, and you don't know. And you can go on the division's website, put in your last name. If you have an uncommon last name like mine and not a Smith or Jones, it'll do a search 1, 2, 3, and it'll either say no matches, or yeah, you got that account out there, and here's how you go about reclaiming it.
You can check other states also,
Yeah,
because
yeah.
it's only each state.
Right.
I found in other states.
I had the Antilles one.
Sales and use tax for remote sellers. Interesting. New Jersey was very quick out of the gate after Wayfair was decided, yet, and New Jersey has said, effective on or after, now it doesn't affect many of our clients because our typical client has their physical nexus in New Jersey, so they're not a remote seller in New Jersey, but you could have clients in New York or other places where New Jersey is a remote state. So New Jersey announced, effective October 1, we're instituting this again with the $100,000 of revenue in the current or prior year, or 200 more sales transactions, and division will apply the Supreme Court's ruling in Wayfair on a prospective basis for remote sellers that do not have physical presence. And this was, as this thing says, last updated August 14th. Okay? Well, the next page in my handout, posted on August 15th, says, on one hand, the Division of Taxation has issued guidance for remote sellers, largely tracks the Supreme Court decision in South Dakota versus Wayfair. The guidance issued in an August 14th notice comes after the legislature's July 1 passage of a remote seller bill that would take effect on October 1, yet Governor Murphy has yet to take action on the measure. And the governor has to sign or normally veto a bill within 45 days, but because the legislature is not scheduled to meet or hold a quorum through the end of August, the deadline has been extended. It is unclear whether the governor plans to issue a conditional veto of the bill. Meanwhile, they'll come out with all their guidance that says October 1st, full steam ahead, and I believe yesterday or earlier this week, which would be Monday since we're only at Wednesday, that the governor did conditionally veto this bill, seeking some, and they mentioned something about it, seeking some tweak in the language. So it's comical that they come out with all this guidance, you better start collecting, and yet we don't even have a law. Oops. Top of the next page, when the legislature passed Assembly 4261, New Jersey became the first state to pass remote seller legislation. How do you pass a bill if it requires the governor's signature and the governor doesn't sign it? I don't think that's, I'm not a lawyer, but I don't think that's passed law. And finally, last item from RIA, just I'm seeing this all the time. I'm sure my colleague Harry in the back sees it as well. It seems like every other day another state comes out with their rules in this regard. So they put out this article that was dated August 15th, so 2 weeks ago. Since our last article, state taxing agencies in Michigan, North Carolina, and Washington announced new economic nexus policies. Louisiana established an enforcement date for its contingent economic nexus legislation. Maine and Mississippi updated the enforcement dates. The Maryland Comptroller proposed emergency regs, and the South Carolina Department of Revenue released draft guidance. And then it talks about what California's doing with the $500,000 threshold. The next page talks about what Arkansas is doing. There's a 5-page article. I only have the first 2 pages, just to show you that these, despite what they said that the states are overwhelmed and not equipped, this somewhat contradicts that, in that it looks like the states want to get their money, do their money grab, and get their share of the pie. Now maybe they're only going to go after the Wayfarers of the world and the overstocks, and not your little mom. And again, with that $100,000 threshold and the 200 sales, you're not going to be getting someone who's got a small little business that they're operating out of their basement, and they're based in New Jersey, and they made $7,000 of shipments to Massachusetts or Georgia, because they're obviously going to fall under those thresholds. Which I think, if it weren't for those thresholds, the Supreme Court might not have decided in favor of South Dakota, because they didn't want this to be just your little mom and pop business operating out of a home office, out of a basement in their home, that's doing $200,000 in total sales, to have to now start filing 30 or 40 state sales tax returns because there's no minimum threshold that they could fall under. I think the $100,000 kind of covers that, gave the justices reason to feel that going in favor of South Dakota was not going to be very harmful to business activity in the economy. That's what I got for today.
Send me a check.
That's fine, that's it for today.
That's it, come on, we need a joke.
It's okay. We had a good turnout.
Where's your teddy bear?
No, no teddy bear.
What's the future date, October 18th and what?
Yeah, October 18th, a joint meeting.
And joint meet, and, that's a
All
co-op?
marijuana's free.
Yeah.
And what's the one in November?
The date, 28th.
November 28th?
Yeah. Keep those on your calendar.
We haven't heard anything about when amnesty's starting.
I checked the website today, there wasn't any more details than you know.
They were asleep at the switch.
Yeah, I know.
You need 90 days.
Yeah, exactly.